If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hello. Happy Wednesday. Happy Fed Day. How's everyone doing? Hope you're all well. Is Oanda available non-US? Yes, I think so. I think Oanda's available globally, actually, at least in most developed markets or developed countries. So, theme of today is obviously Big Powell. Fed is expected to hold rates. We have a 97.2% probability of a hold, according to the CME FedWatch tool. So what I want to know is, what do you guys assume think we are going to get in the forward guidance? I think we've got two possibilities, and I'll run through them in a minute. Tom, good to see you. Grid, hello. Starting with James, yes, indeed. So I'm starting. I'll just quickly show you the schedule for today, just so you are all aware. So there's me, there's Marco on after me, then you've got Alan, then you've got Tiger Berry, then you've got Chris Pulver, and I assume Chris and Nick will be at the same time. Normally they do a joint segment, especially on news days. Is decision already priced in? Peter, yes, the decision's been priced in for a long time, my friend. So as soon as this meeting is done, the markets will begin pricing in the next decision, and it's always pricing in basically what the markets are expecting next. Do I know Bentley? No. Do you mean the car or do you mean the person? If it's a car, yes. Person, no. So with the US, let's take a look at their data. Let's start out with the inflation. Actually, sorry, let's just start out with growth, I suppose. So GDP has come in quite good for the US. We've seen a nice increase here. So overall, we were relatively flat, consolidation or range bound, if you will, during this period. However, recently, GDP has been coming up, which is self-explanatory. That's a good sign. Growth is doing okay. Services PMI also doing quite well at 54.4. However, manufacturing is not quite as good, but not awful considering relatively higher GDP growth, decent services. But yeah, the manufacturing side is showing a little bit of contraction. Retail sales actually come up quite nicely to 0.6. When I say quite nicely, obviously relative to the previous one at 0. Now let's move on to inflation. Overall, inflation is still above target. So in my view, the Fed doesn't have any room to cut rates. And I think obviously the market is saying the same thing. As we've just seen, we've got a large probability of a rate hold. So yeah, inflation is not coming down enough to allow the Fed any room to cut rates. The labor market. Now, NFP has been very, very lackluster. It's been essentially just trending to the downside with these lower highs and lower lows. Previous one came out at 50K, which was an undershoot from the previous, and also the forecast, which is this red dot right here. So forecast was at 66. That's a 16K miss. ADP, not a huge deal in my opinion. However, ADP showed a little bit of resilience coming back up from the negative when it came out at negative 32, came out at positive 41. Still an undershoot from forecast, so not the best, but still a slight improvement again relative to the previous release. Unemployment has been doing okay. Peaked here at 4.6, managed to come back down to around 4.4. So unemployment in the larger scale or on the sort of longer time horizon, unemployment's doing okay. Unemployment claims also doing okay, slight tick up, however, still remaining under all of these forecasts. And yeah, overall, completely fine. So let's just consolidate all of that into the US heat map, which is right here. So there we go. So now I want to ask you, what do you think Powell is going to say? And again, I think there's two reactions. One is very probable. The other one's more of like a slightly funny, but maybe possible. Doubtful, but possible. Sluggy, hello. 79 Jeremy, hello. Hope you're both well. So yeah, as I said, GDP, okay. Manufacturing PMIs not doing amazing, still in a bit of contraction. However, services is doing well. Retail sales doing well. PPI not doing the best in terms of rate cut narrative. Then we've got wage growth, as we've already discussed this, so I won't go over this all over again. But overall, as I said, I do not think the Fed is in a position to cut rates. And again, that's reflected on CME Fed Watch. So what do I think the Fed could come out and say, or Powell? I think there's two things. There's the first one is his normal rhetoric, the labor market is this, inflation is sticky, blah, 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 data dependent, same old, nothing overly interesting. On the other hand, if we take into account what's going on, so if we take a little bit of the context about this, not looking at necessarily the data points, Powell is coming to the end of his term, and there's been conflict between Powell and Trump. I think we should all be well aware of that situation. So there is a possibility, now very minute possibility, but there is that possibility that Powell wants to take a little bit more of a retaliation standpoint against Trump and actually come out quite hawkish. And I'm not saying that is going to happen again. This is more of a little bit of a shot in the dark. It would be quite funny. And I think there is a small possibility there that does happen. Now, okay, in terms of the US dollar, two things slightly interesting here. On the monthly time frame, we've technically broken below this 14-year trend line. So this has been established since back in 2011. We've been just, in fact, what is this, 15 years now. I think this trend line has been on pretty much every trader's view. I don't think there's a single trader that looks at currencies that hasn't at least paid any attention to this. So we've broken that. However, we are on this 200 monthly moving average. Now, whether that means anything to you, it doesn't, it's not a huge deal, but it is something to pay attention to, because we have come down again. We've broken the trend line. We've broken the previous lows. We've come down to 200, and now we're seeing a little bit of a rejection into the decision. So take of that what you will. But I think the main thing really is if we can start closing below these lows and this trend line, I think that could introduce a bit of a nasty selling regime on the dollar. Obviously, with the rate checks, dollar yen's coming lower. Overall, the dollar's not in a great position in terms of public perception or traders' perception, whatever you want to call it. But on a data front, the dollar is actually quite good. So I got this message, I think it was yesterday. Someone asked me, using the Edge Finder, like it's got a score of 63 plus. Why is the dollar doing so poorly? And you've got to be able to separate when the markets are being driven by data and central bank policy and when they're being driven by external factors. So just a quick side note for any of you guys that are trying to learn fundamentals or trying to become more of a swing trader, you've got to be able to differentiate when those times are. So when the markets are running off a shock event, so, something like COVID, a war, rate checks, whatever it may be, versus when it's a standard or quote unquote normal market being driven by the data and policy expectations. So that's sort of the difference. And we're not in a market right now that is necessarily running, or specific to the dollar, not necessarily running off just the pure fundamental data. So that's sort of the situation we're in right now. So it'll be interesting to see what Powell says, but we've got lots of guests on after me. So I'll leave the decision there. I'm sure lots of other people have interesting inputs. Most likely a neutral Fed. Yes, that I think base case, sort of, if I had to put money on it, I would expect the Fed to be neutral, maybe with a slight hawkish tilt. But, as a little bit of a funny meme, maybe it'd be interesting to see Powell take a bit more of a hawkish tone, again, just in more of a retaliation against Trump. But, Powell is always reiterating that he's not influenced by the political side of things. So whether that will happen or not, we'll see. James, how are you? Pretty. I avoid milk. So oat milk, moisturizer, face masks, all that good stuff. It's the benefits of having a girlfriend that's into skincare. It leaks into my routine. So in terms of positioning, looking quite good at the minute, actually. I can't deny. So pound Aussie, still in this position, nothing's changed. I'm waiting really for these lows to get cleared so I can trail my stop to this. Oops, hold on. Let me get my pen. There we go. I'm waiting for these lows here to get cleared and close below. So something like this. And then that will allow me to trail stops. So I'm looking to take profits at around 1.93. Technically, I think this market could head lower, but I trade similar to Nick, but I'm not someone who will just let a trade run and run and run until I'm stopped out with a trailing stop. I do like to have a take profit somewhere. So this trade, for example, is 5.2 or would be 5.19 return if it hits take profit. But in the meantime, while it gets to take profit, I like to just trail the stop. So that's the plan. If we can, again, clear these lows, nice close below, and then possibly a retest here, then I'll trail them down to these highs and just let it run. So the forecast here, the 1.93 has come from MUFG. It's their forecast, basically on a commodity boost. And if we also take into account that the RBA is the most hawkish central bank in the developed markets, is quite clean. Now, New Zealand, Swiss. Actually, let me just quickly go back over to the Edge Finder. What you'll notice is all of the trades that I'm in, or that we're, excuse me, all the trades we're in are on the Edge Finder, either the bullish readings or the bearish readings. And this just goes to show you that, you know, trading doesn't need to be that hard in terms of spending hours and hours on research and drawing loads of lines and boxes, trying to figure out where liquidity is and all that stuff. You can quite literally check the Edge Finder, apply a very simple entry technique or model, whatever you want, and trade the data. And that's all that's going on here. So again, pound Aussie is getting a bearish reading on the Edge Finder. New Zealand Swiss is getting a bullish reading. So technically here, we executed this one, I think it was yesterday afternoon, maybe. I'm not 100% sure exactly what time it was. But we had some Swiss light news. It wasn't like a news release. It was just a bit of a headline that came out. So this pushed lower. However, it wasn't a change in data policy. There was no actual change in the trade. So we were still bullish. Price came down to this 200 moving average, bullish candle close on the H4, and then reclaim. Then I entered this trade, and then I scaled in once we had a bit more confirmation. So I got 2% allocated on this trade, 1% on the first entry, and 1% on the scale in. That's my general risk when I'm confident in a trade. In terms of take profits, just looking to see if we can come back up to some of these previous highs. Ideally, the highs around here at 0.48 would be ideal. That's where we've got to take profits set. Moving on, Euro Aussie. So as some of you may remember, if you've been watching my segment specifically over the past 1 to 2 weeks, I had a big sort of debate with myself. Did I want to take Euro Aussie or Pound Aussie? So Euro Aussie was the more convincing idea. It's the one I actually wanted to take. However, at the time, it was a Monday, it was a US bank holiday, and we just had the Trump news. I can't remember what it was. It might have been Venezuela at the time. I can't remember actually what the news was. Anyway, we had some data or some headlines come out about Trump, and I was like, you know what, this potentially, depending if it escalates and things, could be quite a large mover for the euro, especially if the dollar starts weakening. The euro could strengthen. I don't want to be involved in that, so I took Pound Aussie, just a little bit of a risk mitigator, if you will. So I avoided Euro Aussie due to that. However, due to the fundamental data behind this trade, I preferred it. So now we've got the Pound Aussie that is break even or risk free, and I'm looking to trail the stops into profit. We decided to go in for Euro Aussie as well, and this one was quite aggressive. However, because, as I said earlier, I think I said the Pound Aussie didn't meet the requirements for me to scale into that trade. So we took an aggressive entry here on Euro Aussie, as it seemed like it was breaking the low here, failed to come any higher, and the downtrend is still quite strong. The fundamentals are still very strong. So yeah, looking to just let this trade run with Pound Aussie side by side. Sorry, I know there's a lot of talking. I just need to get through that so I don't get distracted. Right, so let's see what you guys are saying. Hello, Jane. Oh, I've already read that one. DXY really on 95. I know, it's crazy. I have to pull out the ball out Elliott waves. To be fair, actually, I think Marco said that one. I need to give credit for that one. I believe that until the end of the year, 2026, dollar will stay down. Yeah, I mean, Trump said he's happy for it to have yo-yo up and down. So in terms of Trump input, it's definitely not helped for dollar bulls. What I also want to just quickly mention is gold. Now, this is not necessarily a data point, but it's something that makes me a little bit cautious. As some of you may know, I'm not someone who trades specifically on COT data. I don't trade specifically on retail positioning, but I do like to account for noise, like social media chitter chatter, mainstream media, those types of things. And today, or was it over the past sort of 24 hours? Let me pull this up for you 1 second. Here. So we've had mainstream media is now covering gold, and Kramer is bullish on gold. Now, I know that might sound like a bit of a meme, but it is true. So Sky News covering why is the gold price surge. The comments are, is it coming down? Should we buy? Blah, blah, very typical sort of non-trader type talk. Same thing with BBC News. And again, Kramer's bullish on gold, but not silver. So it might be a signal to actually sell gold and buy silver. No, I'm joking, but it just makes me a bit cautious in terms of a short-term move to the downside. Just as we see this sort of, what do you want to call it? Like, I don't want to call them normal people because we are normal people, but you know what I mean? Like the non-traders talk on the metals is starting to pipe up again. It just makes me cautious of a bit of a downside move. And again, the possibility of a hawkish Fed tone coming out, I am looking potentially for this gap on gold to get filled. That would be nice. If we could see a bit of a rejection here, a bit of a reaction, it might be a signal to get long gold. I'm still very bullish, but short term, I'm just cautious, if that makes sense. Hi, James. The dollar is being heavily manipulated to be weak. This flies in the face of the economic strength of the US economy. Yeah, I mean, we did speak about that. It's sort of a different market regime, if you will. Powell hawkish on inflation, perhaps. Yeah, maybe. Thoughts on NZD USD? We'll take a look at that in a second. Everyone's saying they expect Fed to be hawkish, apparently. Yeah, when I say hawkish, I don't mean that they're gonna come out and say they're gonna hike rates or anything like that. I just mean maybe slightly more hawkish than what we've had over the past couple of decisions. Hello, James. Hello, cycling. Is the Nikkei no longer bullish? No idea. Let's see. S&P, CAC Swiss, Russell. No, it doesn't seem to be. Although I was looking at New Zealand yen actually just before I came on stream, and that one's looking quite nice for, well, to be honest, I think I've missed the entry now, unfortunately, because it seems to have started rallying without me. But technically, this was potentially quite a nice buy. We had a strong edge finder reading, pull back to the fib, nice rejection to the downside. The uptrend remained valid. So yeah, overall, I think New Zealand yen could be quite a nice long position if we can get a bit of a retracement on the next candle. That would be a nice potential trade. Aussie Swiss, also quite a nice potential trade. However, the technicals are a little bit more messy, so definitely not an easy trade to get into. But yeah, if you could somehow get into this market, I think the upside is I don't want to say inevitable, but I do see quite a strong potential there. Let's see, Euro AED, Euro NZD shorts for on my next setup. Yes, nice. I think long AUD is still absolutely the play. It's sort of the dominant currency right now. James, are the things with the mentorship? Oh, how are things with the mentorship? I completed 3 days ago and I haven't received anything. David, we check the applications really closely. So either you can follow up if you've not heard back. Well, yeah, you probably should follow up. But yeah, normally if we don't get back to someone, it's because something in the application didn't fit the requirements for the mentorship, whether it be your goals and what you want and need doesn't meet what we can provide, or it might even just be a monetary thing in terms of you don't have the cash reserve to pay for what the fee is. I know that's not the best marketing talk, but it is true. I don't want to sit here and lie to you. Looks like hold on. Yeah, it's flipped on the yen, bearish again. Yeah, okay, let's just take a quick look at dollar yen. Hold on, let me just see what time I'm on till today. Okay, so I've got about 10 minutes left. Just bear with me for a second. Dollar yen seems to be having a little bit of a pullback, but I wouldn't take this too seriously just yet. Short gold, Kramer inverse. Yeah, I mean, again, I just want to clarify, I'm definitely bullish on silver and gold and copper. That's not changed. But I do think short term, we could just have one of those moves. It's just profit taking, very natural. We've seen it on silver. We saw it, what was it, 1, 2, 3 weeks ago? We see it on gold quite often, where we just have these maybe slightly, I want to say larger, but obviously large relative to the trend. These little pullbacks here, just where smart money get a little bit of realize some profits and then look to allocate again. Jokes based on real life events. I'm not sure what you mean. What about GJ? Been long since Monday. Let's have a quick look. Yeah, I mean, to be honest, it's hard to say because I'm just a bit cautious. But if you do have some risk to allocate and you don't mind taking a bit more of a, when I say risky trade, I don't mean risky as in P&L. I just mean risky in terms of the outcome of the trade, whether, stop loss profit. I think this could be a good opportunity. So pound yen on the H4 still is in an uptrend. We've had 3 opportunities really in terms of, come down, come down, and come down. 3 opportunities for bears to continue lower. We've not had that, and the fact we're starting to come back into the 100 and the 50 moving average after rejecting this 200 could be quite a nice sign. I also could see this left side continuing to get corrected. It's very sort of normal market behavior, and then we would continue on the path of upside. But just be, again, very careful. The yen's been quite volatile, so don't take too much risk there. What do I see on the US 30? Not much, I don't think. Let's just take a look. I don't know if it's on the edge finder. Let's just see. I don't think it is. No, it's not. US dollar still getting a bearish reading here. But yeah, no, US 30 is not getting anything on the edge finder that's pointing out to me. However, uptrend. So to be honest, buying makes most sense. But, and the big but to this is, we've got the Fed tonight. So if you're not in positions already, I wouldn't look to put any risk on the table going into the Fed, because like I said, this is a bullish market. I think S&P, Russell, US 30, bullish markets, you would want to be a buyer, generally speaking, but we could get a little bit of downside tonight if we do get that hawkish Fed. Royal Trades, hello, I'm good, thank you. How are you? Might just stay in a range, consolidating, accumulating before wiping out trapped sellers? Potentially, yeah. Can I do Bitcoin? Yeah, I suppose I could take a quick look, and then we can move on to pound New Zealand. I don't trade Bitcoin. I always reiterate this when we look at cryptos, because I don't trade them. I know very little about them in terms of what's moving them, and what's going on. Hold on. Let's choose, I suppose, Oanda. There we go. Right, so what's going on here? So yeah, what I was trying to say is don't take what I say regarding crypto or any or Bitcoin too seriously, because again, it's not my market. It's not something I pay any attention to. So I can give you this technical view. Nice support created. Whether Bitcoin is going to continue lower or not, I really could not tell you. Although I can give you some levels that I might pay attention, or that are maybe worth paying attention to. I suppose from just a technical view, what I would want to see to be a buyer is a pull down into here, potentially take out some of the long positions that are stuck here, retest previous structure, come into the 200 moving average, and then potentially continue its upside. Beyond that, I don't really see too much. The daily's on a downtrend. The H4 is very choppy, overall bearish. So yeah, there's nothing even remotely interesting on Bitcoin for the way I trade, unfortunately. So pound New Zealand. I've got about 5 minutes left, so I'll go through as much as I can until I hand the stream over to Marco. So pound New Zealand coming into support. However, I think I would actually rather be a seller. Oops, bear with me. Oh, pressing the wrong buttons. Do we have anything here? Yeah, pound New Zealand bearish. Yeah. So overall, let's just take a look at the data. Is the dollar being deliberately devalued so they can have a cheaper dollar and export more? Well, I think that's why Trump has said that he's not bothered in terms of the depreciation on the dollar. He's fine with it yo-yoing. I don't think a strong dollar has not been Trump's like mandate or goal. It's just not his priority. So I think there are benefits for Trump to have a weaker dollar and obviously lower rates, but yeah, we'll see what comes out as time goes on. So what have we got here? COT is flat. Retail is long. I mean, actually 83% long on retail. Really nice. Seasonality, I don't pay much attention to, especially when we have strong fundamentals. Trend reading is bearish. GDP, manufacturing PMI. So yeah, overall bearish. Could be slightly better, but I think if you were wanting to be a seller here, what we would need to see, I suppose, potentially you could go for two things. So you would want to wait and see how price reacts on this 200 moving average, first of all, because this is sort of quite a key level of support, double bottom, 200 daily moving average. It could provide some short-term buying. In that case, and if you are confident being a seller, you could be looking at a 50% retracement. So we could see a pullback off this level, come and retest the 50 and the 100 moving average, come into the 61.8 and the 50% fib level, and then possibly continuation lower, pullback, retest, and then again lower. So you could wait for two things there. Again, you could either take a bit more of an aggressive entry and look for this fib, or you could wait for more confirmation, get a slightly worse entry on the retest of this level, and look to enter here. That's the two approaches I would look for. But yeah, as of right now, there is nothing to do because the H4 is slightly extended. And again, the dailies are quite a major support level, so I wouldn't want to be selling it straight into that level. James, what's the general consensus from the CAD press conference following the rate decision? I didn't follow it, but let me take a quick look and see if I can quickly pull something up for you. I'm not even sure when it was. Let me just double check when the kind of the data came out. Oh, it's today, not too long ago. I'm not sure I'm going to have a full recap just yet. Just bear with me for 1 second. Let me see. No, I'm not seeing really anything at all. I would assume relatively neutral based on the fact that, first of all, I've not actually even noticed it, and second of all, I've not seen anything on my ticker. What do you think about Euro USD? Yeah, so I guess we could cover Euro dollar lastly, and then I will jump off. So Euro dollar, really nice correction so far. However, I would be very cautious. So I think what I would, and this is a big think and big maybe, it really depends on exactly what is said tonight. However, and also how the dollar reacts to the current level. So I think base case, or like best case, we get a relatively hawkish Fed, pushes euro dollar down into previous resistance here, meets our moving averages. This could just act as a little bit of a mean reversion move back, again, just to sort of average prices. And then we can kick off a new sort of uptrend from here into around 1.2-ish. So that would be the plan. However, what we need to take into account is 1.2 itself, because we are, or we should, if you're trading the FX market, specifically the euro and the euro dollar, you should be aware that the ECB has verbally spoken out about 1.2. So it's not necessarily hard resistance. We don't have, we don't have a notice saying that we are going to do anything at 1.2. However, it becomes a little bit uncomfortable then. And then it becomes a question of, do traders, investors, market participants really want to be holding euro dollar longs above 1.2? Maybe, yes, obviously, if the fundamentals are there and we've got some reasons to, definitely there's potential, but I would be very cautious about that. So if you are looking to be a buyer, I think probably around 1.2, maybe just slightly lower, could be a take profit, or maybe take 50% profits and trail your stops. It really depends on how you manage trades, but yeah, I'd be slightly cautious buying euro dollar here. And another reason for that is if we go to this monthly, I've been looking at this for a long time, is the level that we're currently at, which is, to me, actually really attractive for potential short plays. Now, I'm not going to go into that here because I don't have time to fully explain. I'm running out of time. So I do apologize, Marco, that's in the back room waiting for me. But yeah, the thing I'd be paying attention to is this. So we're coming into previous highs on the monthly. We've got previous structure here. This is a monthly fib level, although discretionally drawn, obviously. But it's, again, something to pay attention to. And we're still creating these sort of lower highs on this monthly. There is, if we get some sort of reason to be a seller, whether, again, a hawkish Fed, overwhelmingly strong US data, whatever it may be, there is potential there to be a seller on euro dollar, obviously on a higher time frame, so you might want to scale it down, but yeah, that's my input there. So, ladies and gentlemen, I am going to head off. Let me just make sure it is Marco so I can hand it off properly. It is. It's Marco's trading journey on after me, so don't go anywhere. You're in great hands with Marco. He will take over the show. And we do have the Fed tonight, which Chris and Nick, I assume, will be covering with you. Guys, have a good one. Stay safe. Don't get margin called. And yeah, have a good time.
Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello, welcome everyone to my segment. Hope you're having a good Wednesday. So, what's up with the markets? What is happening? I'm in the Nikkei. This is a new position from Tuesday, basically from yesterday. And by the way, this was also a signal in the A1 Trading Discord. If you want to join the A1 Trading Discord, you can do so with a massive discount with the code Marco. I think there's like a 40% discount at the moment. So link in description, A1 Discord. This discount works on the Edge Finder as well. Now let's continue. And also just a second, I need to shut down my washing machine. Okay, so it was beeping at me like crazy. And if I don't turn it off, it's going to beep for half an hour. But we managed to shut it down. Nikkei, why did I take this position? Couple of reasons. First one being, if we jump onto the Edge Finder and we go to the top setups history, Nikkei had a bullish reading when I took the position. So it was around the 9, I believe. That was the first massive confluence. Second reason, technical analysis, massive uptrend on the daily chart, respecting that 20 EMA almost perfectly. So just gradually going higher and not really pulling back more than the 20 EMA. That's a great sign for me personally. Another reason we had the taco trade. So market sold off when the Trump made the threat with the tariffs. Then he went back on his word. Markets went up, and then we had another mini crash because of the potential intervention by the BOJ, but that got resolved as well. So now we are continuing higher. That was another confluence. The fourth confluence for me personally is the outperformance of the Nikkei compared to the S&P. So if we scroll to the beginning of 2025, we go to the plus button, we add the S&P, we're going to notice the S&P is up 18.46%, while the Nikkei is up 35.62%. So the outperformance is pretty significant, and I'm expecting this outperformance to continue in 2026. Looks like there is a lot of money managers, pension funds, hedge funds, big players who have decided to move some money away from the S&P, put it into some other things, or put the new money that they receive into some other things. So I'm talking about the Japanese stock market, European stock market, emerging markets, Brazil, Peru, gold, silver. I mean, if you just slap on gold on this chart, gold, you're going to notice a massive outperformance, right? Take a look at that. So the S&P may not do so well in 2026. I still believe it's going to be bullish, but I don't believe it's going to be a massive mover like some of these other things. I'm actually bullish on gold in 2026, and I think gold is going to appreciate more. The main story, the main narrative at the moment, the main question that is on everyone's mind is on the dollar. So what is happening with the DXY? Why such a huge crash? Will it continue? Is this the end of the world? Is the dollar done as a reserve currency? The de-dollarization trade, or debasement trade, I think that's the name. Is this it? What's my take on it? Well, first, let's zoom out. Yes, we touched 95. We broke a key level of support. And if you go to the monthly, I think this paints a better picture. So if you zoom out a bit and go to the monthly chart, you're going to notice this level of support. Now, this level of support was or is around 7 to 8% lower. That's a lot. That's a significant drop. And we were at this level just a couple of years back. This was 2021. This was 2018. That's only a couple of years. So if we do go a bit lower, if we do sell off a bit more, it's not going to be a problem. I don't believe this is the end of the world. I don't think the debasement trade or let's say that the dollar is going to stop being the reserve currency. I think the dollar will remain the biggest, the most powerful, the most important currency in the world. Everything that you want to buy in the financial markets is quoted in US dollars. I'm talking about stocks. I'm talking about Bitcoin, gold, silver, copper, platinum, oil. Everything is essentially quoted in US dollars, and that's not going to change anytime soon. So we still have a lot of room to go. Financial juice, look at what Trump is saying. Trump, the dollar is seeking its own level, which is fair. If you know anything about Trump and his campaign, Trump wants a weaker dollar. So Trump mentioned it in his campaign that he wants a weaker dollar. So he actually likes this. It makes US exports cheaper. And again, we were at much lower levels just a couple of years back. So I don't think this is a major reason for concern. The next narrative I want to talk about is if you watched the Davos event, where a lot of European countries talked about moving away from the US, selling their US assets, buying other things, buying emerging markets, buying Europe, buying Japan, and sort of ignoring America completely, moving away from the States. Well, if you look at the markets, is that really the case? Let's take a look. We look at the dollar. The dollar dropped for sure. So there is some selling of the dollar. But the dollar is always going to be the reserve currency. It doesn't really matter if the dollar crashes and loses even more value. It doesn't really matter. What matters is the US stock market. If European hedge funds, pension funds, money managers were really serious about moving away from the United States, they would sell the S&P, right? Does the S&P look bearish? Does the S&P look to be getting sold? No. So we are at all-time highs. S&P at all-time highs, NASDAQ really close to all-time highs. Did we go into all-time highs? No, but we are super close. US stock market keeps getting bid. US bond market does not look so bad. Let me see TLT. I mean, TLT does not look so bad. If all of the European investors, hedge fund managers, pension funds actually put their money where their mouth is, they would go in and they would sell a bunch of US stocks and a bunch of US bonds. At this moment, they're not doing it. So at this moment, it's mostly talk, no action, which means for me personally, everything is all right. There's not a crisis in the market. There's not a massive move from the States just yet. There is some, let's say, selling of US assets, but it's not as massive as the media portrays it. And for me, here's my game plan, okay? That's kind of the best thing to do is I'm going to tell you my game plan. I'm, of course, looking at indices. I am in Nikkei. I'm looking at gold. I absolutely want to buy gold. I'm also looking at the S&P. I'm also looking at the NASDAQ. Focusing on the NASDAQ, because if you have been watching me for the last few weeks, you would know that I was closely watching the NAS for a breakout out of this level of resistance, which actually happened. So we finally broke out of this level of resistance. That's a pretty bullish move. We are most likely going to break out of the all-time highs, and I'm going to look for buy setups. No matter all of the narrative, sell US is done, moving away from the US, blah, 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 blah. I'm just going to diversify, to be honest. I'm going to buy the NASDAQ. I'm going to buy the Nikkei. I'm going to look at the DAX, which doesn't look so well at the moment, but that's fine. And I'm going to look at the US market as well. What do I think is going to happen with the dollar, you might ask? So what is the next move for the dollar? Can we trade it? Because as a Forex trader, you should have a rough idea of where the dollar will go. You know, the whole market is based on the US dollar. So if you don't have a clear direction on the US dollar, it's a bit tough to develop trade ideas. But at this moment, I'm not sure. I'm not sure what is the path of least resistance for the dollar. We have hit a crucial level of support right there, crucial level of support. We have broken through it and closed below it. Okay, does this continue? Does the selling continue lower? Or do we bounce higher? One thing that I do know, if you look at the Fed Watch tool, let's take a look. Fed Watch tool, we have 2 rate cuts of 25 basis points priced in for 2026. See? So 32.8% chance for 2 rate cuts to happen. Rate cuts are, of course, bearish. They should be bearish for the US dollar. So the US dollar, by this theory, should sell off more. And the US president, the US administration, they kind of want a weaker dollar as well. Those catalysts should be bearish dollar. But then you look at fundamentals. We can jump onto the edge finder. We can go to, let's see, economic data, heat maps, US. And as you can see, the US overall still looks healthy. So the fundamentals in the United States are still healthy. The numbers are still looking great. That is the counter argument for a weaker dollar. That is the argument that the dollar maybe bounces off of this level. We have a bounce, and then we go back maybe to the top of the range, because this is a definite range. You have the bottom of the range, you have the top of the range. So essentially, I don't know. I don't have a clear view, and I'm not planning to do anything super serious with, like, based on the US dollar. What I do like, I like the Aussie dollar. So I'm looking to play the Aussie dollar. I want to buy the Aussie dollar. It is my favorite currency pair at the moment. RBA, Central Bank of Australia, is the only central bank in the world that is planning to raise interest rates. Okay, only central bank that's planning to hike interest rates, which should be pretty bullish for the Aussie. Most of the other central banks are cutting. The Fed is cutting, which should make Aussie dollar go up. Australia is getting good economic data, I believe. If we jump onto the heat maps, we go to Australia. Yes, 85.71% of data is coming out bullish for the Aussie. That's great. And we have high inflation. So if we go to economic data, inflation, CPI, we go to AUD, we have elevated inflation, 3.8%. That is pretty high. So what must happen to battle inflation? What does the central bank do to lower inflation? Well, they essentially cut, or they hike interest rates. Hiking rates is bullish for the currency. So that's my whole base case for buying the Aussie dollar. Your next question may be, which levels are you looking at? We can put on the fib tool. I would say if the 20 MA catches up, the 0.382 level looks nice. So if that 20 MA catches up a bit, I think taking a stab at it at this level, potentially stop loss below the 618 level, could be nice. My game plan would be to use a trailing stop loss. So if this happens, boom, I'm in, and price continues higher, I can just trail my stop loss below the swing lows. So that seems like a pretty high probability position to have. Okay, let me see the comments. So let me see what you guys are saying. Aizen, hello. Cycling Club, hello. Aizen is long NZD Swiss. Sluggy, welcome to the stream. I'm also in the same position, same stop loss. Okay, speaking of shutdown, there are rumors of government shutdown again. That's an interesting thing to comment on. So, shutdown, US shutdown, poly market. Let's see. Usually if there's an event, I try to look at poly market because it gives you a rough probability of the event happening. Right now, there is basically a 76% chance that a government will shut down. Okay, so those are the current probabilities. Most likely it's going to happen. What happened to the markets in the last shutdown? Well, we had no data coming out, which is not the best for the dollar. I think the dollar sold off, and we could get that happen again. So the dollar could sell off once again if the shutdown happens. Could you place a trade on that? Could you trade it? Me personally, I'm not looking to execute a position just based on the shutdown. But maybe if you have a good edge, if you have a few other examples when the shutdown happened, maybe go short on the USD. So if you want to backtest it, I would go to ChatGPT or Google Gemini. I would ask ChatGPT, give me all of the instances when we had the US government shutdown in the past 10 years. And then you get all the dates. And then you look at all the dates on the DXY. And you see what is the general direction of the dollar after a shutdown. I would think it's bearish. So then you could maybe structure a sell position. If I just go to Gemini and I ask, when did the last US government shutdown start? Let's take a look. I just forgot the exact date, but here's a quick backtest on just one example. October 1st, 25. So if you go to October 1st, that's it. Okay, pretty interesting. Looks like I was completely wrong because after the shutdown, the dollar gained value. Okay, let's see another example. When was the shutdown before that date? Let's take a look at one more data point. December 22nd, 2018. So we go to 2018. We go to December 2nd. This is a bit of a different case. This time the dollar sold off. Well, kind of sold off, but then was mostly flat. That's how you do it. That's how you can structure a new edge. That's how you can structure a trade idea. That's how you can develop a new edge. But thank you, Sluggy, for pointing that out. It's a pretty important event to follow. Of course, if I have anything interesting on the subject, you will get updates in the A1 Trading Discord, in the Marco's Journal channel. By the way, if you want to join the A1 Discord, you can use the code Marco. And also, today I unfortunately don't have a DNA funded challenge to give away, but I do have a code for you guys, a discount code. So A1 Live gets you 25% off any DNA funded challenge. Okay, A1 Live, 25% off any DNA funded challenge. This is the website. These are the account statistics or account parameters. I usually go with the 2-phase, and I focus on the 25K, 50K, or 100K account, right? By the way, this is the full price, but with the code A1 Live, you get 25% off from this price. So DNA funded, one of the best prop firms in the business, and with the code that we have, you get the best price. So I'm talking about competitors, let's say FTMO, 5%ers, E8 markets. All of them are good, but DNA Fund gives you the best price with the code. So that's why I like DNA. Quick plug. And now let's continue with the stream. And by the way, I'll have more free challenges to give away in a few days or a few weeks. So we're talking with DNA. We're getting more codes. It's just going to take some time for us to set everything up in the back end. And then during my streams, during my segments, I will be giving out, I think it's 5K, 10K, and maybe even 25K challenges. Gold to 10K, 8K is nearby. Good morning, Tornier. iGrids, hello, welcome. Have you spoken about gold? I did, but I can do a quick summary because I know you guys love to see gold. I know Nick is in gold as well. He's making a bunch of money. I think he's up $120,000 or $130,000. Crazy stuff. So congrats to Nick. Awesome position. My personal game plan, I'm super bullish on gold. I don't think we're going to see a crash like we might see on silver. I think gold is going to be a fan favorite for 2026. I think the institutions are massively under positioned, let's say, if that's even a word, on gold. I think institutions have far too little gold. And I think they're going to be buying. The big guys, the big players are going to be buying in 2026. So this is not really retail. This is heavy institutional buying, I would say. What I want to see just a bit of a pullback. I can't get in at all-time highs. It doesn't fit the plan. It doesn't fit my trading style. I have to look for a pullback. What I may get, so I slapped on the fib. I looked at the 0.382 level. And then if we pull back a bit, touch the 20 MA, I think this could be a nice entry level. So that is my game plan at the moment. Looking for pullbacks. I absolutely want to get in. The only scenario where I won't get in is if I'm looking at the daily chart and if we get a huge red candle. So if we print a massive red candle, I won't be happy. I won't be happy to take it because that would mean a crash is coming. That would mean the correction is going to be 10, 15, 20%. Which is, of course, a problem for me. My stop loss is going to get crushed. So what I want to see is a bit of a slower pullback, a bit of a slower retrace to the level. That is what I'm personally waiting for, and that is what I want to see. Is Canada cutting rates? I don't think so. Unfortunately, don't have the probabilities for central banks here at the moment, but I don't think Canada is going to cut rates. Or are they? I think they're neutral. I think they are not planning to hike or cut. I may be mistaken. You didn't talk about the US 30. US 30, not my focus at the moment. Dow Jones, it's not my focus. So I have some other things that are more interesting for me. Of course, I'm bullish. I mean, this is a massive uptrend. We are respecting the 20 MA, but I personally have a few other interesting things that I wanna focus on. If you look at too many things, it's no bueno. Your concentration can only focus on a couple of instruments every single day. So if you spread out your work to like 10 or 20 assets, you're gonna do sloppy work on most of them. Much better to zoom in, have 3, 4, 5 assets that you like the most for the week, let's say, and look at those. So that's why I have the watch list right here. But of course, I'm closely watching some other stuff as well, like the NASDAQ. So maybe I should put on the NAS on the watch list just to have it on there. I mean, we're pretty close to the ATH, all-time highs. Put on an alert. Yeah, let's put it on the watch list. I mean, I'm closely watching it already. Aizen is long Aussie Swiss. Robohola, hello. Sutu, hello. Can we look at put to call ratios, please? Sure, I can bring it up. I can bring it up here on the screen. Crowd sentiment put to call ratio. So SPX, but I think you want to see gold, right? So we have a high call volume, right? And this is essentially crowd sentiment. So it looks like the crowd is getting very bullish on gold. Euro NZD, Euro Aussie shorts look really nice upon pullbacks. If we get any, okay, we can take a look. For how long we estimate the USD yen to keep declining until stabilization? That's an interesting thing to look at. So USD JPY, massive crash, but from my research, from my reading, there hasn't yet been an intervention. So this is not an intervention. This was the Fed doing a rate check, and then you had a lot of weak hands that sold UJ. So this was shaking out of weak hands, so the price crashed massively. But from my reading, the BOJ, Bank of Japan, still hasn't stepped in. This is not an intervention. And I think we can actually go a bit higher. I don't have a clear view on this, so I'm not placing any positions. If the BOJ, if the Bank of Japan won't step in, and if they won't do an actual intervention, I think we'll just keep on trucking higher. If we go back to 159, 160, then we could see a real intervention, and then they can actually sell USD JPY. I think this was sort of a check on the pulse of USD JPY. They wanted to see how expensive it would be for them to push the markets lower. From what I can see here, it's going to be very cheap to push the markets lower because there is so many weak hands that they just absolutely sold, got scared, and had an erratic move. So interesting to see that. Let me just see the schedule. A1 live stream schedule. Okay, Alan is coming on in a few minutes. Okay. I think it's not going to continue declining unless we get an actual intervention. That's the conclusion. Can you swing trade with prop firms like FTMO, 5%ers, and DNA? Yes. So I was trading with DNA funded. I was trading a swing trading approach. I unfortunately blew the funded account, but I had no issues. So you can absolutely do it. GBUSD. I would love to accept those challenges, sir. I know you would, but I don't have any at the moment. You're gonna have to join in a few days. We're gonna get more challenges. Okay, Alan is here. So for the sort of final chart, let's do one more thing and then I'm going to pass it on to Alan. Let's do the Euro Aussie that Sluggy recommended, Euro Aussie. Euro Aussie, downtrend, 20 MA, looks nice. What does the Edge Finder say? Top setups. Euro Aussie, very bearish reading. That's pretty nice. I definitely love the Aussie. I'm not a fan of the Euro at the moment. So yeah, if we do get some pullbacks to the 20 MA, this does seem like a nice opportunity to try and go short. I like Aussie dollar and pound Aussie more, but this is not a bad trade. So look for pullbacks and this could be pretty nice to get in. That's about it from me. Thank you very much for watching. Don't go anywhere because Alan is right on after me. And we have the Fed meeting today, which is going to be led by Nick and Chris. I'll be joining in the comment section most likely because it's a very important event. Good luck in the markets. If you have any questions, you can find me in the A1 Trading Discord. So thank you. See you in the next one. Goodbye.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Hello, everyone. Happy FOMC day, one of the more favorite days, right? Lots of volatility to come. And we've seen a slight dip or a big dip here in the dollar. So I'm sure you guys are very curious as to what my thoughts are on FOMC, the possibilities, how I'm planning to trade it. I'll go over all of that with you guys. Also, make sure to join that Telegram channel like we did mention here in that quick ad. Completely free value. I'm going to drop the link or the link's already in the description there. So go ahead and join to go ahead and see the latest updates. As FOMC is coming along, if you guys have to step away or anything and can't stick to the live streams, I will be in the back and I'll be publishing any updates worth mentioning in the Telegram channel. So definitely right now, go ahead and take some time to go ahead and join. But let's go ahead and look at the dollar index here. We did have a slight or a bigger dip here. We're now back at this level of support here, what could be resistance. And this level has held up before twice now. And so this was the level we were all pretty much eyeing here. We flopped below. The reason for that was because the president said that he doesn't care about the weaker dollar. It's good for the U.S. Yada yada yada, and some other remarks like he can control it like a yo-yo. But the fact that the U.S. dollar is actually weak, it's not a bad thing, right? It allows the U.S. to be more competitive when it comes to trade. It'll attract, if the dollar continues to stay somewhat lower here for an extended period of time, then perhaps we can get a somewhat influx of foreign travelers because, you know, their dollar or their currency can stretch a little bit further there. So the dollar being weak is not necessarily a bad thing. I think the question on everyone's mind is it going to continue? How far and how fast, right? And a lot of it will do with today's Fed meeting, the forward guidance and the remarks will give us some clues in that sense. So the way I'm kind of navigating this, I did place one trade very small. I'll go into it, but I'm thinking that the Fed's going to take a more neutral to hawkish stance for some reasons, right? You do have Fed independence being challenged, right? And then perhaps, you know, Powell's on his way out. Maybe he does go ahead and hold firm on that, right? But the real reason why I think they're going to be neutral to hawkish is not so much because of the speculation over what Powell's going to do, but more so the data behind it. So I'm going to pull up the Edge Finder here, the U.S. economic heat map. And if you see at the bottom right here, the USD is at 64% in the blue here. And basically what that means is they've been beating most of their expectations for data points. And when you think of the actual outlook for the U.S., you do have employment improving a little bit. So you had jobless claims continuously beating. You did have NFP that missed slightly before, but then you also had unemployment rate tick lower. And then you have, GDP actually rebounding here. And then inflation, right? The big one is inflation, and it's somewhat sticky. And if you think about it, the Fed, very recently here and even now, has had two main concerns. One is the job market, and the other is inflation. And right now, or for the most part, they were somewhat being tailored to the job market. And now we're seeing signs of slight improvement and that the job market's not deteriorating. So perhaps they can go ahead and pivot into the elevated inflation. If I just pull up a CPI chart here for the US here, you can see that our targeted inflation rate is at 2% and we're still slightly elevated. So perhaps the job market is slowly taking care of itself and the Fed can actually pivot to that elevated inflation. Another thing, right? Another thing that's been happening here, also headline related, is the US v Iran, right? Supposedly we have a fleet of ships going over there, and we need to make a deal or else, the US will use action. Oil, right? Caught a bit on that. So elevated oil for an extended period of time can trickle into the US economy, and oil is actually a forward-looking indicator. So there's a lot of indicators, right? You have your back-looking indicators, but oil is actually a preferred forward-looking indicator. And if you were to get oil elevated for too long, that can trickle into transportation costs, higher fuel costs, and that ultimately gets passed on to the consumer, and that causes short-term inflation. So that's another thing to be mindful of as well. If we continue to see this elevated oil, maybe we can go ahead and proceed for inflation to continue staying sticky. Another thing why I think we might catch a short-term dollar bid here, besides the Fed taking a neutral to hawkish stance, is that if you just look at relative strength versus other countries right now, I'll pull it up here, currency strength. Right now, US is at the top here. And if you notice, like the euro right here, the yen's pretty weak, the Swiss franc is pretty weak. You see that a lot of the dollar strength here is because other countries or other currencies are being weak. If you look at the euro in particular, you're getting at this very interesting level here. This is the trade that I took. So essentially what I did, let me pull up my Epic pen, or I can just draw from here. What I did, very, very simple, and I'll explain it all here. I took a short position here, market order, and it's a one-to-one trade, and the trade is actually less than 1% of the account. So I don't mind losing it. It's a very short-term time horizon. I'm basically trying to see if the Fed's going to deliver that neutral to hawkish stance that I took. But essentially, my stop position is right here above that 1.2 handle, right where this recent candle was. And then my take profit level is going to be right here with this could be support here at 1.79, 1.8. So that's essentially what I'm doing here. But the reason for it is because once you get into the 1.2s for the euro, the ECB does not like it, except one of their officials, Kosher, did go ahead and say that an elevated euro for too long can promote the ECB to go ahead and cut interest rates, to go ahead and weaken the euro just a little bit here. And the euro does not want a strong, super strong euro. It hurts import prices, right? And they actually have the ability to do so. So we were just looking at the actual economic, the inflation here for the US. And if you look at the euros isolated, they're actually below target. So they can go ahead and they do have room to go ahead and, make one interest rate or two, for example, to go ahead and, attack that highly elevated euro. Another thing for the euro too, if you just look at the interest rate projections for the ECB, they're pretty flat, and they've pretty much voiced Lagarde, Kosher. A lot of ECB officials have said, they're pretty neutral for 2026. They're willing to go either way. They're going to be data dependent, and just follow the markets, right? So perhaps that's one thing that they do have to navigate. And the way to navigate a highly elevated euro is to go ahead and weaken it a bit. And so maybe they go and cut interest rates. Now, if I'm thinking this way, why did I just do a one-to-one low risk trade? Well, because when it gets to 120 one time and dips below, that doesn't mean that they're willing to intervene right away. if the ECB or any central bank is willing to intervene, it is because the currency is acting extreme for an extended period of time. So this 1-day candle here that we were at the 120s is not enough. So I'm actually willing to go ahead and short the euro, get a quick exit here if I do get that profit level at the 1.8, and then just kind of wait and see, right? Maybe I can trade this thing higher if the dollar continues its trend lower. Another thing I have to be mindful of as well is the US government shutdown. That's very prevalent. That's if I look at poly markets, government shutdown, 76% chance, come Saturday here. So another big thing that you have to be mindful of, and that's why I'm not actually looking to target even lower, because if you do get a government shutdown, then perhaps you do get another blackout period for the Fed, and they don't like that. That creates a lot of uncertainty. Usually the dollar will take a hit on that. Safe havens will continue to appreciate. And so that's why I'm taking a short-term time horizon here. But nonetheless, short trade here on the euro. I'm thinking we're going to get a neutral to hawkish Fed. The data supports that, the Fed can stay higher for longer. The data also supports for the euro that they're able to go ahead and cut rates if the euro stays, elevated for too long. So I think that's what I'm going to be approaching it. And then longer term, right, if we do get the euro to go ahead and chug higher here, recently, if we just look at 2021 levels in the past, anything at 1.2s is pretty much, capped upside for the euro dollar. So just looking at this chart here, we were pretty close to it, right? But every time we get here, if you just look left, 1, 2, 3 times, once we approach these levels, you get these steep drops. And then this is the cool nature about currencies is they tend to range over a long period of time. So if we do end up getting up here, I'm actually really looking to participate, right? I can build a hefty position very safely, because if I do think on the back of my mind that, upside is somewhat capped at these levels, I can start a position small. And if it continues to go, I can build on that position responsibly and then ultimately get these higher big moves, right? Like if you look at the euro dollar from here to here, that was 1,800 pips. If you look at the euro dollar from here to here, that was 2,700 pips, so on and so on. So maybe this is another attempt there, right? And then if you just look at the dollar, if we were to find ourselves up into here, which kind of, is the parallel level to that euro dollar resistance, right? If we can somewhere get into the lower 90s here, that's a fantastic trade. That's a good risk to reward. I can build a position responsibly, yada, 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 and trade it higher. So that's basically my thoughts here for the euro dollar. Is Trump speaking right now? Not at the moment. Merry Christmas. I mean, happy FOMC. Sluggy, good point. You also have the Euro India trade deal that could be happening here, and that's a clear rotation happening. If that deal gets solidified, those two in itself make up a quarter of GDP, so that'll be another place to go ahead and park your money long term, right? That could be another very safe currency to do it. And the euro does take that responsibility. Oftentimes when people flee the dollar, they go into the euro. So if that Euro India trade deal does come to life and it does get solidified, then absolutely the euro can make its way up into these levels here. But I'm ultimately looking to short them because the euro does not want a super strong currency. Let's see. Elimination on tariffs, 9% of goods. Let's see what else is happening. Any charts you guys want me to look at though for FOMC? We're starting to see, for the most part, dollar catching some breath here, relieving some of the losses that it took. You see dollar index kind of getting back into this level of what could be resistance. Gold. It seems like every day gold shoots up like 2-3%. This is crazy. So what I think with gold, I think gold will present very minimal pullbacks, but it's very possible that it continues higher, especially come Saturday. If you do get that government shutdown, then over the weekend, then perhaps gold can gap higher. A lot of people are eyeing that 5,500 level. It doesn't seem too far away, especially at the pace that we're going with gold. So yeah, that's one thing that you have to be careful of. The other thing is, let's say you do get a slightly hawkish Fed, then perhaps gold can present a slight pullback here. But I think ultimately the path of least resistance for gold is going to be higher. especially if you consider the recent US-Iran threats. And if things do escalate on that front and you do get attacks, then of course gold and silver is going to continue higher there. So actually, if I'm a gold trader, if I'm in that position and we do get a slightly hawkish Fed, and so the dollar appreciates, and if the dollar were to appreciate, then you'll see a dip in equities, you'll see a slight dip in gold and silver as well. And so maybe if I do get the pullback opportunity, if it's meaningful enough, right, then we go ahead and buy gold. But honestly, if the pullback is slightly shallow, I wouldn't be interested in it. This is just one of the things that you have to accept, right? As a trader, is when the move is pretty much run away, it's run away. There's not much you can do after that. AUD CPI effect, Alan. So yeah, I made a video on this, right? AU CPI actually did come hotter than expected. Let me fact check that. And for those that are new to the stream here, new to FOMC, the Fed, right, they take a data-dependent approach whenever they make the decisions on interest rates. You know, interest rates ultimately affect the direction of currencies. And so we're able to look at all of the data that the Fed looks at, the Fed considers via the Edge Finder. So go ahead and get you a copy here. This is what I use. A lot of the traders on the platform that live stream here used it as well. James, Marco, myself, Nick, I believe Chris as well, Ivan's. We all use a copy of an Edge Finder for a reason. It is super, super helpful in data, collection and consolidating everything. But AUD CPI, let's go ahead and look at that. So the cool thing is you can go ahead and look at every single major economy. You have US, New Zealand, the yen, pound, all of that good stuff. So let's look at it. AU CPI came in 3.8%, so it's still elevated, right? That's why, and let's look at the interest rate projections as well. You can actually look at the interest rates data and the projections that the country is going to do. So let's look at AUD isolated by itself. So they're looking to hike their interest rate and they're going to stay higher for longer. That is bullish for the Australian dollar here. So maybe, what the video I did was if we were to get a pullback opportunity on the Aussie dollar, I'm looking to be a buyer. And so what that would look like if I go down to the 4-hour time frame here, this is when we broke out. Ultimately, guys, I do want a pullback up until here. That is 3.2% away. I don't think that's going to be the case. So let's be realistic here. Let me put a Fibonacci retracement level just so I can get an idea of where we stand. Okay, this looks possible. If I can get somewhere here, which is the lower end of the channel, then I'm a buyer of the Aussie dollar. So that's what I'll be looking at, guys. And then as far as target goes, I don't like trailing stops. I usually like having hard targets on FX. But we do have a very obvious level here. So, and we pretty much got there. So what I would do, enter here at that 6.68422 area, give or take. And then I target the 0.714, somewhere around here. So if I can show you the trade, this is if we get the pullback. If I don't get the pullback, I'm staying away because you have elevated risk here. So let's see, 150 pips. Okay, that's pretty good. It's a 2.6 RR, right? You have the Aussie dollar pullback into here. You have your stop loss right below this. This was before resistance, potentially support again. So even if we make our way down here, you still have another line of defense, and then ultimately trading it up into the 7100s area, 71.5. So that's what a pullback opportunity in the Aussie dollar would look like. I'm going to put an alert here as well. I like that trade. First, let's verify with the Edge Finder as well to make sure it's still looking good. We're going to highlight the major currencies only. And look at that, bullish reading on the Aussie dollar. So that looks good. So I'm actually looking to be a buyer there. So hopefully we get the pullback. Hopefully we get that neutral to hawkish Fed, get the dollar, get a slight bid there. I can get a quick hit on the euro dollar, and then I can repivot into the Aussie dollar as well. Especially when you have that risk of the U.S. government shutdown. If that does happen, as we just saw here, we do have a 76% chance that is going to happen. Currently, things can change, of course. Then I would love to be, more invested in the Aussie versus the dollar. So that's going to be a good trade. And then the reason for the Aussie dollar, let's look at why it's getting a bullish reading here. economic heat maps. We'll look at the AU. Okay, yeah, PMI is doing good. CPI came in bad, which in this case, bad means elevated, but that's actually good for the Aussie dollar. And look at that, you have unemployment rate actually ticking lower as well. And then if you look at the AUD impact, look at that, it's getting 86. And let's compare it against everyone else as well. So eco surprise. Wow, so Aussie dollar is actually getting the higher reading out of everyone else, right? So that's really, really good. So yeah, good trade. I'll look for a pullback. That's gonna be a good one if I get the opportunity to do so. Did we go over DXY already? I did. If you want to rewind it, be my guest. Essentially, I'll go over it really quick here as well. You did have a sharp sell-off here. A lot of it was fueled with Donald Trump's comments about the DXY. He doesn't mind it going lower. DXY being low is actually not a bad thing, but you do have risk when it comes to other currencies as well. So like if the euro dollar, approaches, the 95 or sub 95 levels, if it gets really, really low here, then you have the risk of countries like the euro acting to go ahead and weaken their currency. Higher euro dollar does impact import prices for the euro dollar. The ECB does not want that, so they're willing to intervene if the euro dollar gets too elevated here. Anything in the 1.2s is risky, especially once you get into this higher end of the channel. So if you look at 2021 prices or even 2018 prices, once you get into this 1.24, 1.23 area, you do have the risk of the euro intervening. So as far as the dollar index, I'm looking for a slight bump here today for FOMC if the Fed takes a neutral to hawkish stance. And the reason why I think that is because you have employment rate, or the employment for the U.S. getting slightly better. You have sticky inflation in the U.S. You have CPI and PCE still sticky, but then you also have GDP as well performing pretty well. So the case for the Fed holding rates is actually a good one. I think they can take that stance. And so that's kind of my thoughts on the dollar index. Slight bump, but then ultimate dip, but then any dips too far is risky. So that's it summed up. Yeah, Bala, I'm on the same page as you. So any movement from FOMC will be looking to fade. And so that's why I took a short position here on the euro dollar. I did a market order. I'll go over it again for any newcomers. Where is the brush? Market order here, stop here. And then my take profits right here at this, what could be a level of support at the 1.18. Very small trade, less than 1% of the account. So I'm willing to take it. And then if I can get that quick take profit, I can repivot into something like the Aussie dollar. So if the euro dollar, takes a hit, obviously the dollar basket will appreciate, and so you'll get Aussie dollar lower. Hopefully we can get into this 50 to 61.8% retracement level, and ultimately I'm looking to fade any DXY strength up into the upper end of this channel here. And then if you look at it, Aussie dollar, this next level of resistance for the Aussie dollar is this 0.715, 0.716. Somewhere around those lines, and we're almost there. We're halfway there. So if we can get a pullback and continue up here, that's going to be a fantastic trade. And then obviously once we get there, we have to consider what other central banks are saying, if they're willing to intervene to go ahead and reduce their currency, yada yada yada. So that's what I'm looking at. Also too, why I don't want to be too invested in the dollar long term. You do have that government shutdown as well, which could definitely influence the dollar. Won't be satisfied until the DXY is in the grave. Yeah. It came faster than I thought, I'll be honest with you guys. I think another level of support here, if I go down to the weekly time frame, somewhere around here, this 90-92 level, if we just continue in this direction. But I think some have argued, there's a trend line here as well for the dollar. Something like this, give or take. So dollar index is also somewhere here. So maybe this I'm think of this fresh here, but if the dollar index does break below, stay below, break retest situation, then the next leg could be, trading it to the downside up into the 92s, 90s levels, and then ultimately looking to be a buyer there. If we do get dollar index at the 92.90, I'll be pretty happy. I think the risk to reward on that is phenomenal, right? You can buy it here, stop somewhere right here, and then you just have all this to target, right? And currencies, for the most part, they range bound. So I think that'll be a good play, but way too early to tell, honestly. Way too early to tell. For those that are tuning in for FOMC, and if you can't stick around for the whole thing, I would definitely recommend joining the Telegram channel. I'll be posting. I hop off here in about 5 minutes here. I'm going to pass the show off to Tiger Berry, but I'll be posting updates on the Telegram channel. If anything meaningful comes up, anything market moving, anything you guys should know, I'll do my best to go ahead and deliver that. And I do that on a regular basis as well. So I'm always putting updates in here. Oil is one thing, it's staying elevated, right? USV Iran, the implication of that, also the dollar, right, and the inflation and the influence it can have on EU's rates, and so on and so on. So every day I post the two biggest charts, the charts that you must know. That way you are up to date on the fundamentals, and it's a very slight read. It takes you about 1 to 2 minutes, and you're updated always on what's going on in the world. So think of it as like a daily newsletter, and I promise you guys, if you tune in and if you read it on a daily basis, you will be more in tune with the markets and you will improve your trading, I promise. And also too, there's always bonus clips, like Nick's always pulling bonus clips as well. There's giveaways, all this good stuff. So it's definitely free value. Take advantage of it 100%. Uh, 92, let's do it. Yeah, 92 and then 89. If that's ball out's next call, I'll be looking at it. You could definitely consider it, because this is a very important level right here. You have this level of support where we're at the moment, and then you also have this higher time frame trend line as well that we're leading up against too. You saw we had a slight reaction to it here. So maybe this is a place where buyers and sellers really have a fight for it. And the ultimate decision, if we were to break below this and stay below, then 92 is a 100% probable, especially with the way things are going. You have a rotation out of the US going into the EU, other countries as well. Definitely possible. You heard it here first with Popular Road, DXY to 92. Not financial advice. Anything can happen in markets. However, the fundamentals, will ultimately decide that choice. And on this channel, on this live stream, we stream every single day, and we provide you the latest fundamentals. And subscribe to my YouTube channel too. You guys have been really showing some support there, so I really appreciate it, guys. Let's see how Euro doing. Things are pretty stalled out here for the most part. The big moves have played out, and I think markets are just consolidating here, or just staying somewhat flat. If I go down into the lower time frames here, yeah, we're just hanging out. Most part, euro, dollar, pound, Aussie. And that's very normal right before a major news release. So the markets price in an expectation, and then they wait for the release. And then if the expectations are met, for the most part, markets just continue trading, very gradually there. But if you have the market see something that was not expected, then markets will quickly reprice that. And so that's why we all watch FOMC, so we can get some forward guidance and some more insight as to what the market's going to do ultimately later down the road. Is it possible to trade one currency pair? I don't know what you mean by that. So like the Aussie dollar is a currency pair. But if you want to just trade, for example, the Aussie or the USD in isolation, you definitely can. In the US, you can trade the ETF. So you have like ETFs for the yen, ETFs for the euro. And then on the futures as well, you have like 6E, which is the euro, 6J, which is the yen, stuff like that. So you can trade them in isolation, but ultimately the direction and the price is pretty much the same. So, if euro dollar is going up, then 6E is going to go up, and the euro ETF is also going to go up as well. So the price action is somewhat similar, but yes, you can trade them in isolation, technically. It's possible, but definitely not recommended. Yeah, it depends. Aussie Swiss, yeah, I would assume Aussie Swiss is taking off, because you have the Aussie looking to raise interest rates and all that. And earlier maybe last week, and here I can show you guys, so I'm not just saying stuff. Yes, look at the Swiss right here, 0, right? The Swiss basket was getting beat up really badly here. Let's look at the edge finder for confirmation. Top setups, we'll do miners only. Aussie Swiss is getting a 14 bullish reading. Wow. So if I do get, maybe this is another way I can play the Aussie basket as well. If I were to get a pullback of some sort, how I would play this, let's see. Target this ultimate level here. I'll bring this down lower. I mean, it's definitely possible. I'd wait for a pullback of some sort. Let me go down to the 4-hour. Honestly, yeah, maybe if I were to somehow get here. So if I get that Aussie pullback that I'm looking for, then perhaps Aussie Swiss does somewhat this, the same, and then I can be a buyer here as well. What's going on with my trading view? Yeah, that's a good trade. It's getting a very strong bullish reading, which is something we, of course, love to see on the Edge Finder. So I would definitely be looking at that as well. Thank you for that. We'll see. Another thing to consider, though, that could really hinder this trade is if you do get government shutdown, USV, Iran, safe haven appetite. If you get a lot of safe haven appetite, then the Swiss franc will catch a bid, and then that will possibly stall out this trade somewhat. So it'll be just a matter of which currency pair is the strongest, and that's the hard thing about currencies. It's hard, but it's also use it to your advantage as well. If you have you want to trade a super strong currency versus a super weak currency. So if you have Aussie dollar, which is super strong, but then you have the Swiss franc, which is also super strong as well, then that can kind of make the trade somewhat flat here, and it seems like we've been doing that here. But we do have Mr. Tiger here, I believe, coming up, so let me verify. Cool. He should be on his way here, but I'll stay here on the show. In the meantime, James, if you can just give me a ping whenever he's here. But yeah. So that's the thing with currencies, right? Ultimately, you want a strong versus a weak, or a weak versus a strong, right? The two opposite ends of the spectrum, that is where you get the best, cleanest moves. And the Swiss franc fundamentally is very weak. So I do agree with you guys there, that bullish reading on the edge finder. But if for some reason you go into the weekend, lots of escalation, things like that, and the Swiss franc catches a bit on that, then that can really hinder the trade a little bit. Hey, Bashy. What's up, man? You missed the segment of my show. I'm pretty much over here. We're just waiting on Mr. Tiger. Hello, Phantom. How you doing? It's okay, man. You can always rewind. I didn't go over too much here. I basically went over the dollar index. I went over the euro, the implications that a highly elevated euro can have. The ECB is willing to intervene to weaken the euro a little bit, just because they don't want a super strong euro. And then we just went over Aussie Swiss, the Aussie dollar, pullback opportunities. My bias here at the moment is that we can get a slight bid on the dollar if we get a neutral to hawkish Fed, just because the data supports that a little bit. But ultimately, I'm looking to rotate back into a long Aussie position. So the euro dollar short that I have is very short lived. It's a 1-to-1 trade. I'm looking to target this 1.18, and then I'll be out of there if I do get it. And the risk is very small, less than 1%, so not too bad. We do have a risk of government shutdown as well coming in. Poly markets giving it a 76% chance that will happen. So that's one thing that I'm mindful of. So I'm betting against the dollar but not for too long. I've been on for 30 minutes. No, Nick. Well, Nick's going to be coming on here during the actual FOMC. So Nick and Chris are going to take over there. They're going to give their commentary. And again, guys, if you guys have to leave during the segment, I know the stream is somewhat longer here today, but join the Telegram channel and I'll be posting updates, all the relevant updates, everything that you must know, things that'll move markets. I'll definitely go ahead and post them in the Telegram channel. And so you guys can always stay up to date. I'll put the link there one more time. You've been DCAing short euro since 1.16. So I think with the euro, you have somewhat of a cap. Longer term, once you get into the 1.2s, ultimately anything 1.22 or 1.23 is where you get that intervention risk. But yeah, 1.2 is usually that level here. So we'll see how things react here. Let me just reply real quick. I'd like to get your thoughts though. Do you guys have any biases as far as FOMC? Is the Fed going to be dovish, hawkish? Are we going to see a continued slide in the dollar? I think for the most part, though, I've been seeing around that people are thinking we're going to get a hawkish Fed, but obviously we can always get surprised. But that's kind of what general consensus is telling us here. So someone said they went long soybeans. Yeah. Sugar is also looking undervalued. Let's see what soybeans are doing just for the heck of it. Futures. Hey man, they're looking pretty undervalued here. They're looking pretty bad. Sluggy's expecting FOMC to be neutral. I think support for DXY, no cut growth, good employment, not so bad inflation is okay, I guess. Yeah, I mean, you have the Fed being challenged, the Fed independence being slightly challenged there. They're very much pushing for lower interest rates, and the data supports that the Fed can hold for a little bit. You have, the two things that they were very much focused on was employment and inflation. You have employment getting slight improvement there. So jobless claims, I'll show it to you guys just so you can see. But the trend in jobless claims has been looking pretty well. Come on, jobless claims, employment. Here, let's go. Labor markets. Jobless claims here just trending lower. Like, look at this, right? So it's improving a bit. If I go to the economic heat map for the US, let's go here, US economic heat map. You have retail sales previously in the month improve. PMIs improve. Growth is doing pretty well. You have PPI and PCE still sticky. Wage growth. You have unemployment rate ticking lower, which was the big one. So yeah, I mean, I think the Fed is pretty well off to go ahead and hold rates. Employment rates taking care of itself. Inflation is still slightly sticky. If you just pull up the US dollar here, we're still above target, 2.7%. So I think the Fed can take a neutral to hawkish stance. You're heavily long AUD CHF, biggest position. I hope it works out. It's getting a 14 bullish reading on the edge finder here, which is pretty nice. The only thing to be mindful of is Swiss franc getting some appetite because of safe haven status. But if that doesn't happen, then I think you should be good to go. Everyone knows the Fed not cut or interest rates. So do you think the upcoming news will have effect on the market? Yeah, so markets trade heavily on expectations, right? Sentiment and expectations is what drive the market. So we saw leading up into the event, you saw, if I just pull up the 4-hour chart here on the dollar caught a slight bid. And I'm addressing Hunter's question. So the markets tend to go ahead and price in their expectation, and then the actual meeting happens. If the and at the moment the expectation is neutral to hawkish. So if the market sees neutral to hawkish tone today, then nothing much will happen. You might see a slight grind higher, a continuation, but the big moves happen with any news release, whether it be NFP, CPI, or FOMC, is when you get something that was not expected. And so markets quickly go ahead and reprice that. So for example, when markets are expecting a super strong NFP on the US dollar, you'll see 1 to 2 days before, the US dollar will go ahead and grind higher, and then it'll stop like the session or a couple hours before the actual release. You'll see that it just stay flat, and then when the news release actually happens, you'll see one of three things. You'll see it either super spike up because it blasted through expectations in a good way, or it stays flat because it just met expectations and that's it, and then markets pivot into the next release, or it completely misses expectations, and that's when you see these very, very fast respikes, correction moves. So that's basically what happens with markets and data releases. So what you see right now is, what you see on the dollar is what the markets think is going to happen right now. Cool. Alrighty. You guys have a early surprise guest here, so I'll go ahead and wait for him. But yeah, we'll see what happens. Dollar index, I'm eyeing this 96.5, something lower here. You have this support here. We're seeing this wick. You also have this longer term trend line here. So we'll see if this ultimately holds up. We have Mr. Trader Nick here. How you doing, man? I think he's coming up right now.
What's up, Alan? How are you, man?
Living the dream, man. How are you?
I'm good. Counting down to this Fed meeting here today.
Yeah. Do you have any expectations? Any speculations on what you're looking at?
I'm pretty much thinking that most likely Fed's going to come out still sort of unwilling to move either direction, not be too hawkish, not be too dovish. I know that's kind of the default answer ahead of these things, but when we look at some of the data, it just feels like you have a case for both directions. You still have inflation remaining somewhat sticky, still above 2%, but then at the same time, you have the jobs market showing some signs of weakness, and in the current administration that, ultimately I think will put in someone there who's very dovish. So I'm really curious if if there's any sort of taking a moment to vouch for Fed independence today. I think that would be a really interesting dynamic. So I guess we'll see.
We'll see, man. Well, thank you for that, and I'll leave you to it. I do have to run here, but everyone, like I said again, join the Telegram channel. If you're unable to stick through the whole duration of the stream, I'll be putting the updates, anything meaningful, anything market impactful. I'll go ahead and keep you guys up to date. But Nick, thank you for that, and we'll see you guys later.
Thanks, Alan. See ya.
All right.
Sweet. Good stuff. Yeah, shout out Alan. He went a little extra. We had someone scheduled for now, but I think that they had something come up or they're just not responding. You guys know and love Tiger. So Tiger, if you can hear us, we miss you on the live stream. Anyways, taking a look here at markets where we're at, a couple hours out. Today is a huge day, by the way, guys. There's so many different things taking place all at the same time. You have obviously the Fed meeting, but right after, we also have huge earning announcements for major U.S. stocks coming out after the bell. I believe you have Meta. Is it Meta? It is Meta. So you have Meta coming out. You have, I believe, Microsoft. 2 for 2. Yep, Microsoft. And Apple's tomorrow. Gosh, I got all 3 of those right. I didn't even look. You know what that tells me, right? That tells me I need to go outside. Anyways, yeah, we have big tech earnings coming in after the bell today, which are super critical to this market. And it's interesting, how range bound the U.S. stock market has been. I'll just share some information with you guys. The last few days, I've been doing a little bit of a reallocation within my portfolio, which I do every year around January, end of year into January on the A1 trading shows and content base. We, a lot of our traders here, like James, Chris Paul, you guys probably familiar with the crew. A lot of us will do like a webinar event in November, which we did. It was amazing. It was so much fun. We also kind of prep for the year ahead. And around that same time, now into January, this is a big time for me personally where I do a lot of reallocation. And I do reallocation, if you don't know what I mean by that, I take a portfolio approach to my trading. So in fact, you know what? I'll just show you guys. It's not super fancy, but I'll show you what my thinking has been about how I kind of want to transition. So just give me 1 second here. I'm going to just pull up portfolio allocation. Yeah. Okay. So here's my thoughts. Nothing magical about what I'm doing here, but I've been kind of just like conceptually thinking about how much I want to allocate to each strategy. And within that strategy, each longer term and shorter term hold within my portfolio. Trading strategy is one side of things, but this stuff, there's a lot to it. So when I talk about taking a portfolio approach, which I always encourage people to take a portfolio approach, a portfolio approach, what that insinuates is that you have a couple different strategies or approaches within your overall investing journey. So I have trading strategies, I have investing strategies, I have option strategies within my portfolio. Why would I do this? Why not just do everything trend following momentum, the macro plus momentum approach that I always talk about in my videos? Well, the reason for that, and it is the biggest component of what I do, but this year it's become less than last year. Like in 2025, my allocation to my macro momentum strategy was like 80%. This year, I'm going to scale it back and diversify more, not necessarily in just assets, which I will diversify further in assets, meaning adding some different stocks, adding some, not a big crypto guy, but commodities, holding things longer term, and taking the portfolio approach significantly can change the smoothness in your equity chart. So let me explain this, and I'm gonna ramble here for a second. So I hope that you guys are cool with this. I hope you're enjoying this. If you are, hit that thumbs up button. We got 388 people. We got a couple. We got time to kill. We got the Fed meeting today. Okay, so if I were to let's look at each one of these really quick. So I have 4 strategies within my portfolio. The one everyone knows, and let me blow this up a little bit bigger so you guys can see what I'm talking about here a little bit better. I'm excited about this. This stuff is so fun to me. This is cool. Okay, so what is most popular on my YouTube channel and what I talk about the most is my macro plus momentum strategy. What's not so fun about the macro and momentum strategy is that while it produces ginormous, flashy, huge trades like the gold trade that I'm in right now, which is ridiculous, I have to take a level-headed approach and understand that what's also not fun about this strategy is that this is how it looks most of the time. And then I have the big winner, right? That's what the equity curve to my macro and momentum trading by itself would look like, okay? If I only traded swinging for the fences strategy, which is what is most popular on my channel, it's what I do the most of, it's my favorite strategy, but if I only did that, this is psychologically not so much fun, especially if you enter into a real bad one, which I've had plenty of. In 2022, I had this for like a full year, and it was no fun. I had a 30% drawdown just getting chopped to pieces. Why? Because I was mostly just trading that one strategy. Since 2022, I have made the effort to learn new things, to implement new things into my trading career, and I've added strategies, okay? Let me explain. This strategy has incredible upside moves like the gold trade. And this is, I'm struggling with it right now because psychologically I feel weird. It feels like I'm bragging about this trade. And I mean, I kind of am in the sense like, hey, this trade has been amazing. This gold trade's ridiculous. But at the same time, the full context is this is what my actual trading results look like if you were to draw like a line of best fit. So yes, the gold trade looks ridiculous by itself, but we also have down $40,000 months to capture those huge trades too. So this strategy, I love it. It's my favorite. It's my bread and butter. It's my go-to strategy, but it's not my only strategy. And by implementing in more strategies that I also love and have tested thoroughly and feel very confident with, I can smoothen this out. And that personally is a goal of mine. I don't want to have returns that are subject to having a terrible, terrible year and then having all in one gains, right? It's too much pressure on one strategy. I love the strategy, but what if that strategy has 5 years of really poor performance? I want to diversify, not just in asset, but in strategy. Now, this is advanced stuff because I know a lot of people are still figuring out their first good strategy. So I know this topic, this conversation is not for everybody. I'm just kind of walking you through what I'm personally going through. That's what my channel is all about. So that's a big one for me. But I also have a strategy that I use that is the wheel strategy. If you don't know the wheel strategy, it is a strategy in which you are trading options. You are selling cash secured puts, covered calls, iron condors. There's different ways to do it, but it's an option strategy, in which case, without going into the in-depths about what that strategy, all the mechanics of it, in green, let's call this the wheel strategy. It typically looks like this. You're collecting, and then you have a big drop. Collecting, and then you have a big drop. Collecting, big drop. Collecting. And when I say collecting, what I'm talking about is premium. Within this strategy, you collect premium when you sell options. So this is strategy number 2. All right, cool. Strategy number 3 is ETFs, themes, investing. This is long-term stuff. This is, for example, I think cybersecurity, is going to be a long-term winning place to invest. That is my personal opinion. It's not financial advice. Long-term, if I get dips in cybersecurity companies, I could potentially buy something like the Bugs ETF or CIBR, cybersecurity ETF. I could add this to my portfolio. Now this, what does the equity chart look like on investing? It could be like this. 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 But long-term, good companies with solid fundamentals, a growing economy over the next 10 years could be a spot to be. Okay. So investing, you have the widest, you have a huge range. So let's just say that we invest and we have, let's say that the market rolls over a little bit this year, and I pick up, some shares of cyber, and I build a little bit more. And long term, let's say it looks like this, right? I can take profits from the macro momentum strategy and I can throw it into investing. Stock picking. This is another thing that I do. It's not my it's not my highest conviction spot to invest, but I do like to pick stocks. I like to look for companies longer term as well. And let's say that the overall return, let's say the market has an okay year, and then it has a not great year, and it has a great year, right? What we're doing here at the end of what we just did, I'm talking about my portfolio approach, because what this allows me to do is it allows me to ultimately smoothen what my interaction with the markets looks like. And I put it all in one portfolio, which is the Webull portfolio, the portfolio that I talk about and show in my videos. I am planning to reallocate a little bit in that overall layout. I haven't fully decided exactly how I want to allocate, but I'm just telling you guys this because, again, this is what I do on my YouTube channel. I talk about how I approach the markets. And while I love my momentum and macro strategy and have had an incredible couple years with it, I also recognize that I want to manage this like a professional. And a professional doesn't look at a trading strategy as like, let me get a quick payout. A professional is like, I want to be here 10, 20, 30, 40 years, and I want to maximize my potential gains while minimizing my risk. And so what I want to do is add strategies to my overall stuff. These two are more investing. These two are more active trading. Top two are more active trading. Bottom two is longer term, just investing, right? So the average equity curve, you can produce a smoother return by adding in strategies that are not super correlated, okay? One of my most one of my favorite topics to think about in markets is how do I add in strategies that are uncorrelated to one another? AKA, how do you become a hedge fund? A hedge fund, what does a hedge fund do? It adds in strategies that are hedged against this performance of just buying and holding the market. Because what happens if you buy and hold the market and the market does incredible? Well, then you get the pink line. You get an excellent overall gain. But what happens if you buy the stock market and the next few years are just terrible and it takes you 10 years to get back to break even? If you think that cannot happen, you are living in denial of history. History has happened many times where stock market returns are flat over a 10-year stretch. That's why I trade in the first place, is I don't want to have a 10-year stretch where I don't make any money in the markets. I want to make money in the markets longer term, not necessarily every day, every week, every month, every year, but I want overall to generate steady profit in the market. So that's my approach to doing it. Not financial advice. It's just what I do. And that is my overview of my game plan for 2026. It's kind of top of mind for me. So I figured I would give you guys a little bit of a discussion on that as we wait for our next show host. I believe Chris Pulver's coming on in 5 minutes. Yeah. So that's the overall goal. Anyways, just a quick check on some of my positions. The Nikkei jumping here really nicely. Gold is the elephant in the room, which is just an unbelievable move. Take a look at the weekly time frame. I mean, everything on gold looks overbought. Every time frame, every technical signal would tell you, hey, this thing's pretty stretched. Take profits, get out of there, take partials. And it is incredibly rare for me to have a move like this, where I've been able to trail my stop loss so many times on my initial trade, and I'm still in the position. But again, going back to that conversation that I just had about, this stuff, right? The line in black represents the momentum strategy that I use. I am definitely in this event right now. But it's very possible that in the next year, I also go through some pretty troublesome drawdowns. And what looks flashy today, I think you kind of have to take as just another trade in the overall strategy, right? That's why I'm trying to stay as calm and as patient as I can with this trade. As far as I'm concerned, yes, this one trade is wild, but I also have losing streaks to pay back. I have future losing streaks to try and protect downside risk from. So yes, this trade is crazy, but it's sort of the whole point of my strategy is swinging for the fences. And when you get this move, you have to capitalize on it. So anyways, I still think gold has upside. I do not think that just because technicals are overbought means that it has to come down. We have clearly seen that again and again and again. It doesn't mean that, gold's going to go up forever, because it will have, I'm telling you, there's going to be a day. I don't know which day, and I'm not here to tell you when it's going to be, but there will be a day where you look at gold and it has some disgusting red candle. It's going to happen. Please be careful with gold right now. If you are frustrated with gold, I would say it's better to walk away. But a lot of people, what they're going to do in this environment, and please don't be one of them. I've given this speech 70,000 times on my YouTube channel. So let's do the 70,000th one. Okay. A lot of people are going to look at this and be very emotionally frustrated by it. Very few people are going to be loving what's happening in gold. Unless you are a buy and hold gold person, you love this, or you have a strategy that is very similar to mine. Very rare that people are going to be liking this. A lot more people are frustrated by this move. A lot of people are frustrated by this move. If you feel frustrated by it, meaning you are frustrated you missed it, you are frustrated that you're short and it keeps going up, you are not alone. Most people probably who are in the trading community, most people trading gold are frustrated by it. People don't like trading at all-time highs. People find it very difficult to know when to join. At what point do we know when it breaks and reverses? This is a difficult chart to trade. Like, don't let it fool you. This is hard for traders. This is excellent for people who have invested in gold, who are just sitting in it and it's just going up every day, or people who trend follow with a trailing stop. This is wonderful. But for most people, this is challenging. So what do you do? What do you do with this chart? Well, the answer, and it's not a fun one, is probably to walk away from it. Probably not to touch this thing if you are looking to initiate new trades. The reason is a lot of people who have been shorting gold are probably very much underwater. They've lost a lot of money. They have been very frustrated by it. And there's a good chance that a lot of people are emotionally trading gold right now. They're just shorting this thing and literally just hoping and praying that it has some sort of drop. And someone will eventually get it right. Someone will be the lucky jackpot winner at the casino that calls the big drop in gold, and it will, be flashy and get a lot of likes on social media. But for the vast majority of people who are trying to short gold, they will lose their accounts, and they will do it again and again and again because they are emotionally frustrated with gold, right? If you are on the other side, you're like, I have missed this thing and I've been bullish and I'm so mad that I took profits right here, or I took profits right here, or I took profits right here, and it's, just kept going. A lot of people have been frustrated by that. They too can make a mistake by chasing, right? If you're up here and you're like, it's just going up every day, it's going to go up again. If that's your mindset and it doesn't go up and it starts to drop and you have no stop or you have a huge size, you will be kicking yourself just as hard. So my opinion, again, not financial advice, I'm just sharing my thoughts and opinions and years of doing this. The best thing you can do if you're not in a gold trade, in my personal opinion and approach to the markets, would be to walk away. Wait for it, right? Be patient. There have been plenty of times where there was one time, yeah, there you go, not financial advice. There's been a couple times in my trading career where the most agonizing thing in the entire world for me, the most frustrating thing that can happen in the markets for me personally, is when the NASDAQ has been ripping higher, like just straight shot moves that I've missed out on. That really hurts. That to me, I don't know why, that is just the one thing that just gets under my skin the most. Is FOMO is the hardest one for me. I can take a losing trade, I can take a string of losing trades, but when I'm bullish on something and it rips without me, it's agonizing. And I know a lot of people who are going through that right now with gold. So you're not alone. You're not crazy. This thing is ridiculous. This move is unbelievably wild. And I would just issue caution on it because a lot of people are going to lose a lot of money and the volatility on gold is very, very high. Last thing I'll do, because we got to bring in Chris Pulver here, and I'll throw over the stream for him for a little bit, and I'm going to go get some water. Look, the average true range on gold is absolutely broken, okay? The average true move, let's go 200 bars back, and let's just look at this style. And when I say broken, I'm not saying it has to stop. It could keep going. Look at the average true range. You're talking about moving $60 an ounce per day right now. We used to move 20. This thing is so volatile, and a lot of people are going to get hurt by it. So please be careful. Size down on gold if you're touching it. Wait for your setup. Don't let emotions get to you. A lot of people will make a lot of mistakes in this. Please don't be one of them. Please trade safe. Be careful out there. It is Fed day. Up next, we've got Chris Pulver. I'm going to play this quick break, and then Chris Pulver will be here to take over the stream. Stay tuned.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
What's happening, everybody? Well, I brought the gold chart up since Nick was just talking about it. And I mean, look, it's great if you're in it. It's frustrating if you're not. It's testing your patience and kind of making you feel like I just gotta buy some. Look, I'm gonna have a little history lesson here. I can't bring myself to do anything more than the participation I'm already in, which runs from buying gold back here, adding more gold over here, adding more gold over here, taking profit here. So long, long, long. In the big picture, it's like I did a pretty good job with the highs right there. Now, when this position was done, after multiple years of adding to gold, that is profit. Now, I added more on that correction we saw back in October that is now up to fresh all-time highs. That is a fraction of the position that I built the last 3+ years. Okay? Now, I'm going to take you back to 2009 and 2011 because on a daily time frame, this is the one thing that is helping me stay disciplined and patient for just some type of volatility ahead. I also think, and I'm curious if Nick comes back on and joins me during the little previewed FOMC, something smells off in the market. And that would be the fact that we have gold just soaring to all-time highs, silver soaring to all-time highs with tons of volatility on both those precious metals, platinum going crazy, the dollar's down to the worst start in 40 years, plus another 4-year low. And somehow the VIX is at like 16.9. Like we had a little run from sub 15 VIX to 21 all the way back down to 15, and we're back at 16 and change. It's like the market is so complacent with just poking these all-time highs at 7,000 today. So anyway, I just think in the next 30 to 60 to 90 days, the market's going to give us something to talk about, and it could be the bubble type move and the capitulation type move that we're kind of getting on gold and silver right now. But this is my history lesson. Take this chunk right here. This is the bar count going back to 2009, and when gold was off to the races after a great financial crisis and after a bottom here around 675, 680 or so. We got back above the 200-day moving average, and this is the last time that we tested it back in around April 09. Okay, now since that point, I'm going to zoom in here to make sure I'm not off by much. So this 200-day moving average in red. Yep, so this would have been April of 09. All right, so April 09 to that run, this bar count above the 200-day moving average stretched to here is a capitulation type move. And you can see here that we go up and pull back. We go up, we pull back. We go up, we go sideways, pull back. We go up, we pull back. And then it went up, 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 up. This move, by the way, you see my bar count? It's up to 610 bars. Big volatility. Tested the high, 620, and then straight down to the 200-day moving average at 630. Right now, we're at 590 bars. Okay? Now, I'm not saying that it's got to happen today, but I'm thinking that in the next, let's say 30 to 40 bars, maybe 50 bars at most, I would think that this market's going to have some type of snap type move. Now, that doesn't mean that we can't go higher, because this top here around 610 bars from the 200-day moving average, when this was all happening, this market stretched about 21% away. And this is what has caught my attention for now. Somebody guess how far away we are. Do you think we're further stretched away or less stretched away from today? So I'll say that again. We capitulated here back in 2011, got up to about a 21% move above the 200-day moving average, and then we smashed back below it. That set up a multi-year top, by the way. Okay, could it be different this time? Sure, it could be. But this is why I am thinking that there has to be some volatility ahead. And this is what is keeping me on the sidelines from adding aggressively at these crazy all-time highs. I will add more to my gold, okay? But even a test of any moving average is where I want to add to it. Even the longer-term trend out here is where I want to add to it. It is hard to justify from being like a patient trader, disciplined trader. It is hard to justify why you would buy right here, other than you just have to. If you want to scalp this little bit with tiny little stop loss, that's fine. You can scalp with a plan. You can trade gold, but you got to have a stop loss plan, right? If you're trying to invest in gold, I can't be happy about a position here at 5,300. Okay. I mean, 53 maybe does what? Goes to 5,600, maybe goes to 6,000 and then falls all the way back down to 4,000, you know? So we are above 20+%. Here's my 200-day moving average. Here is my current price of gold at all-time highs again today. And we are 27% overstretched. Even back with a great financial crisis, it was 21+%. Now it's 27%. So, you know, I think that nowadays the market is just like bigger, faster, stronger. And the market is clearly building a very strong kind of one-sided narrative that, you know, is this the debasement trade? Is this the sell America trade? Is this the distrust in the U.S. system, the fiat system? Like all these things are kind of being vocalized here. And obviously people are prognosticating on all these things to make it seem like this is the death of the dollar. This is the death of America, blah, blah. It's the same crap that's been going on for 2 decades. If anybody's ever heard of Stansbury and Associates, it's a net newsletter for death of the dollar and death of America for 2 decades. Has any of that happened? No. So it's just a trade, but I want to add more gold. It's just, I can't do it here. So if we are on the verge of this being like nearer to the top than not, I can't buy these highs. Okay. So gold and silver making a great run. Silver, by the way, after a massive shooting star on this daily time frame, you know, we're getting 2 days trying to test again. What would be kind of reassuring about silver would be if we fail at the 118 handle and we start to put in some type of consolidation or some type of topping pattern. Gold has yet to do that. Okay. So do you want to know why I think gold is outperforming silver right now? I mean, I don't mean outperformance in percentage terms because silver has been crushing it this year. Year to date, silver is up. What year to date? I mean, embarrassingly, I want to say it's up like 30 to 50% or something like that. Year to date, silver is already up 57%. 57% in silver. And gold is no slouch, but it's certainly not up 57%. But gold is still up for the year about 22.5%. That's good for an entire year in an index. That's great an entire year in an index, but it is a commodity. And it is behaving like the wild times that we've had in the history where you talk about all these crashes and rips and capitulation moves in oil and gold. And now we have silver. Now we have copper. Now we have platinum. All these things are just, you know, just blowing off left and right. So it's an exciting time. But as Nick said, and I will echo, it does come with a lot of risk. I do think that the risk right now is if you are in a heavy position near these tops, you're gonna hate that position. Because any type of nasty volatility, you'd be better to just take a bite, take a little bite, take a little nibble, dip a toe in the water. And if price goes and consolidates and then wants to break out, you can maybe take another stab there. But if we get a pullback, I'd much rather have one little test, trade my levels, invest an overall position again, and just let this market look like a technical, like a proper technical chart. Okay. I don't think that price will go up forever. And you know that it won't. I think that price, after getting this far removed from the 200-day moving average, this many bars away, this percentage away, that we're not that far away from having something a little shaky happen in the markets. And I don't know if that actually bleeds into equities or maybe this rotation into gold, silver. It's like because so much profits have been achieved that maybe this starts to play into, you know what? Well, here's another non-US play. Here's another distrust in the fiat system. Here's another, you know, anti-dollar play. Here's another decentralized, you know, something that's a little bit of a rebellion play with asymmetry. If Bitcoin gets some love and drives it up, I mean, this is a pretty pure AI play, as you know, maybe the markets and stable coins and stuff become a big reality here in the next 12 to 24 months. Okay. So look, I know it's exciting to talk about gold. I hope everyone's in it and I hope you're all profiting from it. And I hope you're all trailing stop losses because at some point it'll probably turn. I am the trader that's participating a little bit after, you know, showing that, yeah, I've had a pretty good run. I've been happy with gold and silver. Okay. What's funny is being happy after buying gold, and taking profit up here. Somehow I look at this and I'm like, I'm not happy anymore because how did I miss that move? Well, this was part of my trading plan, was to start trailing into, you know, my measure moves. Silver was to go from basically $20 to $50. That was my plan move. It got there. The fact that silver went to 118, holy crap, that's way further than I thought. But my plan was hit. My target was hit. So I took most of my profits. But I'm back in. I'm still participating. I'm up like 30, 35K in silver. I'm up like another 5 or 6K in gold. It's not a big position, but I want it to be at some point. I want to be like adding back in where I think this is a really good kind of permanent play in the portfolio. I think what's happening here is because of the market caps, you're getting a lot of kind of exodus out of the bond market, and people are just parking it into gold. But I do think this comes with a lot of risk. I think right now you're flirting with some very overstretched technicals that I have to bring your attention to. I've seen this stuff play out before where I've seen bar counts at 300 bars seem like a lot. Now we're at nearly 600. That is madness, But at some point it'll figure itself out. Like I said, I'm surprised that the VIX has stayed this low and this quiet and this contained as the market continues to poke all-time highs. So right here, let's go up to this chart. Here's today's candle. Okay, so if I am right with this little rising wedge pattern, does the market, use this retest of the rising wedge to work its way back down in the next 30 to 60 days? February, March, April is typically a pretty good weakness window for the equities market seasonality-wise. You'll see that in your edge finder. Additionally, by the end of this week, so we have an expected pause for the Fed today. We have Mag 7 with Meta, Microsoft, and Tesla. We have Apple tomorrow. We have Chevron and ExxonMobil on Friday. We have PPI on Friday. And we potentially have a government shutdown at like a 75% probability. Another government shutdown. Is that good? I mean, if the market ignores all that stuff, awesome, I guess. But it just seems very weird that the market is going to shrug off like literally everything and just keep going higher in the S&P, higher in the NASDAQ, higher in gold, higher in silver. Because then I think that we would be, having this conversation. Let's say this does this for the next 3 to 6 months. I think I'm having a legitimate and educated conversation on an everything bubble, which means there's good stuff to happen. Like if this keeps grinding higher, that's good. But if we have a weakness window, I wouldn't be surprised to have some type of pullback here. Okay. Maybe some type of correction even further. And once this is done and troughs, then we have the ability to get back up to highs again and maybe higher, which I'd be happy. I'd love to see the market at, 7,500 this year. But if we can start at 6,200, that at least gives me some reward to risk that's favorable. I don't want to get to 7,500 like this. I don't want to get to 7,500 like this. That is not an enjoyable market. If we have super low volatility, I'm going to have to grind my face off for that trade, which is fine. But I'd rather have people get scared out. I'd rather get opportunities to buy in and stack up expirations like it did last year. Get the VIX up to maybe 30 or 40, and then see that thing retreat back to sub 20 and get a good volatility crush and also sell a lot of premium. So that could be nice for some alerts to come up. Okay. So we'll see what happens. I do have some interesting defense trades going on this week. By Friday, I'd like to see a price is either at or below 69.50, or I guess equal to 69.95 to I'd say about 70.05. I have some profit traps in those areas. And then today I put one on between 70.35 and 70.45. So all these levels to me by Friday close, these are big profit traps in my options trades that have anywhere between, trying to think, the minimum would be like maybe $1,200, $1,300 minimum profit targets. And if we're below 69.50, I have upwards of about $2,500 of profit. So we'll see. So if I'm below 69.50, that's kind of easy for me to have a net result. If we're at 7,000 or 70.35, or I guess I should say like 7,000 to 70.45, there's about a $1,500 profit trap up there. So there's some weakness in the middle, and I could get stuck in that. But by Friday, end of day, I'm going to be managing this stuff to figure out if I can carve out a net winner. Okay. All right. I think we beat up the gold, silver stuff a little bit. If you have any questions, feel free to throw that in there. Today for the heat map, right now we have 62% of stocks declining, and we are actually down. I mean, this week, what was interesting, we saw like 53, 54% of stocks declining, and the markets were going up all week because most of your gains this week, let's go S&P. Let's go so far. Can we do a 1 week performance? Okay. Look at who's leading the pack this week. Market cap is leading the pack. Microsoft is up. Amazon is up. Meta is up. Google's up. Apple's up. Nvidia's up. All these massive, $3-4 trillion companies are up in green. Why? Because they've been underperforming since October last year. So everyone talked about this big rotation into small caps, big rotation into mid caps, moving away from the Mag 7. Well, you can see here that it's the drug you just can't quit. Everyone loves the Mag 7. They got into kind of some oversold territories, and on paper, they're still very valuable companies. There's earnings coming up, so I think the market uses an opportunity to kind of front run the earnings that's coming out this week, because they'd expect to deliver. Top and bottom would be pretty solid. Is it enough to rip to all-time highs? No, we'll see. Let's go to Mags. Okay. So here's the comparison. So go Mags versus IWM. Okay. So when this is going down, that shows that the small cap Russell has been outperforming the Mags, and you can see that here pretty steadily since December, right? December to present, and then the last few days has been up. Go back to where this thing peaked here in October, November. It's been a big rip by the small caps and a stall by the Mag 7. So that underperformance in the Mag 7, you can kind of see that rotation back into large cap tech. Okay. If you go to Mags versus SPY, same thing. The SPY has outperformed the Mags. You go to Mags versus QQQ, a little bit outperformance in the QQQ recently. So a little bit of reflexive rally. A little reflexive rally in Mags recently, but very sideways here, Mags versus QQQ. Okay. So I guess that begs a question for me, like, do I want to stick to the big picture Russell and, be all in on small caps this year, all in on mid caps this year? My answer is no. I don't mind taking income trades. I don't mind taking a stab at it. But if we have a pullback to this level, that is a good spot to be buying small caps, right? Look at the trend. Okay. Look at support. So if I can sell premium down here, if I can add shares on pullbacks, then we can look to see if we get to all-time highs. My measured move is 300 to 325 on IWM. So if I can buy it 250, 240, 230-ish, take it up for 70, 80, 90 bucks a share, I'm pretty happy with that trade. Okay, but I want to pull back first if we get it. Okay, S&P. Is this a broadening pattern? Could be. It could be. I'll connect the dots there. I thought more recently we had what looked to be a pretty clean rising wedge. Okay. And this is the only thing that I'm questioning. We just hit 7,000 on S&P, big milestone, intraday high. So if we are going to, celebrate 7,000 for a moment and then have a bit of a correction here, there's still really good support. There's still really good support in our moving averages to find a chance to buy a dip. Now, that would be like a seasonal correction, February, March, April in that window. If it gets a little uglier, if let's say we have a 1, 2, 3 wave move, look left on the chart. I think this is a good opportunity to buy. If you want to wait a little bit patiently, make sure this clears the trend line, then you start positioning for that trade. Get confirmation, stay out of the way, get back to these highs. Okay. If that doesn't happen and all this market does is grind higher, grind higher, grind higher, grind higher, that's fine. All I'm going to do is adjust that. And I don't love that chart. When this market is going to grind and grind and grind and grind, look, if we break the structure, we take out any lows, my concern is that we have a correction coming. So I don't like we're at all-time highs and we're staying at all-time highs and it just grinds. The easier trade is get a correction, buy that dip, and then we're off to the races. But if it is just slow and steady to the upside like we had in 2017, that is not a fun environment to trade. It's a fun environment to hold, I suppose, but it's not a fun environment to trade if that's where the market is going. And I think that would be highly, highly manipulated, okay? And that will likely lead us to a lot higher volatility in the near future. So if you look back to 2017, that was 2017. What did 2018 do? Break, rip, break. It started to widen out. There's tons of volatility and lots of broadening patterns, and it went up to 2019, 2020, and then fell in COVID, and then off to the races again. That was head spinning volatility for literally 3 years. All of 2018, 2019, 2020, until you bottomed out during COVID, and then this thing was off to the races. And what did that take? It took $6 trillion of liquidity to do that during COVID. So if it wasn't for that emergency measure that the whole world took, I don't think we'd have this movement that's 2 to 3 times higher. So 2017 was a challenging year because it was such a, it was almost like a forced, suppressed volatility market. And if that happens now, it's like, that's just because this market's in Goldilocks. It knows that the path of least resistance is up. It's going to be permanent vol suppression. And there are a lot of levers and forces that will kind of prevent things from running over. You'll kind of cap all the volatility. You'll cap all the outliers, and the market just continues to do what the market does best, which is trying to grind higher. So, we'll figure it out. And if the market is, going to go sideways and going to chop around and, going to have some plus or minus 2% or plus or minus 5%, that's fine. If the market melts up higher, that's okay. I mean, I've got some premium in. I will be very patient. I've got, systems in place that I'll take like a 5 to 10% buffer and try to basically scalp the market for, 30 to 60-day moves. So anyway, that's that. All right, that's SPY. Qs. Okay, NASDAQ just tested the recent all-time high, which is back in October. Again, with FOMC today, what happens? We might break through. Is this the same type of pattern? I mean, you could argue that that was a rising wedge, but it really wasn't because we kind of broke the structure here. But if this is I guess you can call this high and this low, and this would be an ascending wedge. So what got us here were bulls, and this is where the indecision takes place. The bulls can maintain this and we break, well, then we're off to the races. And you can measure the move. You can measure the NASDAQ to basically this swing and measure that breakout, and we're talking NASDAQ probably substantially higher. Okay, but if it stalls here at the top, we're probably coming right back down to these 2 very significant candles and possibly a test to make it a 3rd significant candle. This was October 10th. This was November 20th. And if we settle back in for like another, day of infamy, like a single day sell-off type day, I wonder if it's, down here again. But that structure seems to be very, very strong support for the market right now. Okay. So that was the 20th of November, 10th of October. We remember those days. Those were like 3 standard deviation moves days intraday. And as soon as it was Trump tweeted about tariffs on China, next he tacoed it and the market was up 3 days later. And then in 5 or 6 days, it was back to the top again. 1 day sell-off post-NVIDIA earnings. We bottomed out the next day, ripped up in 3 days. We're back to those highs. Market didn't even care. But it was a one-time move where the VIX was up to like 28. The VIX was up to 28, 29. After that, it retreated to 15. So this capped volatility, like I said. Okay. Markets can play all sorts of games. We got to trade. All right. Dow. I posted some trades and pulver alerts on the Dow. When we had a flare up in the VIX, so this recent spike up into the 20s, I did a trade on the SPY, did a trade on the Dow, did a trade on the Russell. I put a couple other trades in as well. I know we have some earnings this week. Like I said, Meta, Microsoft, Tesla today, Apple tomorrow. Amazon got pushed out to February. But the Dow, I'm using this April low. Using this April low as a chance to, if I'm going to own the Dow, I'm going to own it way down here. So my trade it's a ratio spread, which means I'm willing to own it with a big fat profit trap. I'd own the Dow at like $340. So is it coming down there? Probably not. So it's most likely going to be an income trade for me. So it'll help me make, $300 to $500. But if it dips, I'm going to start allocating, maybe buying some shares, keep this option trade running. And if we can, scale in for some shares, get this thing back to highs again, take the gain. I just don't like buying at highs. I don't love it. Russell. Great start for the U.S. and Russell, up 6.53 year to date. A little bit of a dip here, is up over 8% just a couple days ago, and now it's given back a little bit. Everyone's talking about this major rotation. I'd be careful what you wish for. I think small caps could do fine this year. I don't know if they're going to be 50 to 60% like earnings are expecting. I could see small caps doing okay. Could I see small caps up 15, 20% while the S&P's up 10%? Sure. 15, 20% while the S&P's up 5%? Maybe. but I don't see 60% without the S&P and the NASDAQ being up 15, 20%. And that's a possibility. We might still get there. But am I all in on Russell? No, but I want to buy some dips. So same thing. Do we have a pullback? Pullback, look for some dips. Off we go. It's established a nice breakout. It's cleared all the structure. Now a buying opportunity, buying opportunity, buying opportunity, buying opportunity. If it channels out, trade the channel. Okay. I mean, everyone gets in these trades and they think like, I bought it here. Well, if it pulls back, you got to be ready to buy there. That's the better trade. If it goes to all-time highs again, there is a potential channel, right? So do you take some profits? Maybe. Or you just wait to accumulate more and accumulate more until you have a profit target. And then you get out of your trade, which I'm happy exiting. Okay. But as we said, rolling into this year, it's like, this will be a good year for traders. I think every year there is always a lesson. Good or bad, there's always a lesson. So 2026's lesson could be, man, you talk about this crazy trap that silver and gold set. You talk about this crazy trap that volatility. I mean, we had all this stuff happening geopolitically. The markets climbing the wall where we're hitting all-time highs. And look at that 20% correction that came out of nowhere. Look at the Japanese yen, blowing out the wall. And it's not the Japanese yen, by the way. The dollar is what's getting blown out right now. The dollar. And by the way, how many of you are bearish on the dollar? Like, I'm talking in positions right now trying to still push bearish on the dollar. Type in DXY bearish if you're bearish on the dollar. The reason I say that is because I don't think the dollar is going to be bearish. I'm not bullish on the dollar, but I think that the only trade that I like right now is maybe a little bit more downside on like dollar CAD, maybe a little bit more upside on New Zealand dollar, because my Aussie dollar hit my profit target. Dollar CAD still has room to drop to maybe 3,200. Euro dollar just hit highs. Pound dollar just hit recent highs. Dollar yen's been falling 650 pips. But look at this from the technical side. High, low, high, low. Here's your symmetry. Okay. I think that this symmetry is going to set us up with a flat pattern. So having this low, I think this market sets up some type of flat pattern in here before we maybe proceed lower. I think that this might just be an ugly kind of shock and liquidity grab to the bottom. I wouldn't be surprised if the dollar pivots here. I'm not trading that. Okay. I'm not long the dollar. The only one that I really like is New Zealand dollar long because it still hasn't hit my profit target. But if this is a fake out to the dollar and we head up to 100, 101, that could be what ignites a gold correction and silver correction. That could be also a little bit of a dip in the equities markets. But I mean, we know Trump is kind of ignoring everything with the dollar. We know the Fed is probably watching, but right now it's like the dollar getting weaker is almost acting the same as the Fed not cutting rates. If the dollar gets weaker, that's having the same type of international flows and improving exports and improving the other countries' currency positions as it would be if we were just cutting rates and we were being dovish. So it's almost like the Fed doesn't have to cut. We're getting all the kind of weakness in accommodation by just having a weaker dollar. Okay. The crappy part is the dollar gets weaker, you need the S&P to go higher. Dollar gets weaker, you need gold to get higher. Dollar gets weaker, you need Bitcoin to go higher. Because dollar getting weaker across the board, everything to do as a US, like you want to travel US to somewhere else, it's more expensive. Our cost of living at even inflation dropping to 1.18. What is true inflation right now? 1.16. But guess what? We've had 5 years of price increases. So to see this, you're like, oh, prices are not going lower. Prices are going up slower. But we've had 5 years at about 4% inflation. So now prices are up and are permanently higher. And so going at a 1.16, that just means that prices are going up slower. So unless this goes negative, prices get cheaper if we go into deflation. But the nice thing is okay, this is a big improvement, but we are at like a 5 to 6 year window of prices getting really, really expensive very quickly. And now things are kind of leveling off. But if our purchasing power continues to weaken, if our dollar gets weaker and prices stay the same, it's like, that's not good. So I do think like there is a legitimate narrative, like the sell the dollar, sell America, repatriating. I think that is what this world is kind of grabbing onto right now. Does it make me bearish on the U.S. markets? No, it doesn't. If anything, it's like the U.S. stability is good for the world. U.S. stability is good for the world. U.S. liquidity is good for the world. A weaker dollar is good for the world. This is why, late last year, we talked about having some international exposure. I am in SCHY, looking pretty good. I've been in this thing since the Liberation Day. And before that, I was in it, when this thing was moving around 25. I got the Liberation Day dip at 23. I've been holding this thing with a break even around $24. I mean, it's up $7 a share, but I've got enough shares that it's up a decent amount of capital. I'm also in, I'm trying to think, EWZ is Brazil. That's looking pretty good. I bought this thing at $25. ILF is Latin America. Okay, I bought this thing at 22 and change. This is all non-US. Okay, I'm in Japan. Break even is around 66. It's up to 85 bucks. I'm also in Fez. This is Euro. I'm in this thing since the 50s, like low 50s. It's up $15 a share. This is all non-US. Like, it's not all of my portfolio. It's probably added up to like 10% total of my chunk this year. So my equities exposure has about 10% allocated to non-US, but they're all doing really well. And I do wonder, like, if gold keeps running up, if silver keeps running up, if the dollar gets weaker, if the U.S. markets are resilient and stable, but not necessarily gangbusters ripping bullish, non-U.S. trades, like, this is their time to shine. I have an African one. I think it's what is EWK?
AFK?
AFK, that's right. This one. I've been in this one since $20. It's up to 29. So, I mean, every one of those non-U.S. plays, it's somewhere between, $10, $15 a share positive. Like, that's not nothing. That adds up pretty nicely. It's helping me outperform the start of this year because the S&P for the year, Nick, is only up like maybe 1% or 2%.
Yeah, I think it's like 1.5%.
Yeah.
2%.
So when you've got out of the gates, you got a lot of non-U.S. plays up, 6, 7, 8% for the year. Gold's already up 20+%. Silver's up 50+%. Like, yeah, it doesn't have to be perfect. It just, now that you're on here, dude, I got to ask you, what do you think that we have a VIX event in the next like 30 to 60 days? Something just smells really, really funny to me that this market just can't do this for the next like 60, 90 days. I feel like something's going to have to like rattle this market a little bit.
I've been shocked to see gold do what it's doing without the VIX going insane. I've never seen gold make this kind of move this quickly without something going on. Like, when you think about, what was going on in post .com era and 2008, there was some craziness going on. You had some really high VIX readings. It's very interesting to me that you have sort of this bond market freak out taking place, and it doesn't have more impact on the stock market. I really think that this would have been, if you had told me like Japan freaking out, dollar index dropping like this, I would have actually thought the stock market would be down 5, 6, 7, 8%.
I mean, I would have thought so too. Look, I mean, that chart that you had up was a monthly on gold. Like, that is, it's like almost offensive.
It's just broken.
Ridiculous it looks. Yeah,
it
for
is.
sure.
It's just insane. Chris, I was talking about this earlier. Maybe I'll share my thoughts with you again on this. Just from my perspective, because I know you do the same kind of thing. Every year around this time, I sort of talk about allocation and rebalancing of how I want to look at things. I know you like to do your pie charts and things like that.
Yep.
Just wanted to share this with you. I kind of have 4 things that are going into my portfolio in terms of how I'm thinking about things this year. I'm going to allocate a little bit more to the wheel strategy this year.
There you go.
Be a little bit more on the sell premium when I get the opportunity to. Macro momentum strategy, which is where I'm trailing stops and things like that. I'm actually lessening my approach to that, which it's been a phenomenal strategy the last few years to be riding trends. It's been a trend follower. It's kind of safe haven in some ways, but I'm also looking at ETF themes investing and stock picking, kind of allocating up or allocating, kind of diversifying things here. And of course, within this, I heard you talking about it, ETFs and stock picking. If you're talking about holding stuff longer term, that's where you have the opportunity. Like, do I want to go international? Do I want to allocate more heavily towards defensive types of ETFs? Or you have all sorts
energy.
Of
I think energy, you can't go wrong this year. Like, we are, I think any volatility we see in 2026 will also be like the AI trade is the positive narrative, But if we have AI bottlenecks, if we have build out bottlenecks, if we have constraints where the energy grid is strained, we have rolling blackouts, we have this crazy cold front through half the country right now, like all these things in the US, I think it puts a strain on the energy side, which is good for energy prices. It's good for the scarcity. I mean, that's also why like gold and silver, copper, platinum, palladium, like all these things are running pretty hot. You know, and I'll say this, when you see commodities running like this, it's typically not a strong bull market. Commodities like this are usually like the last breath of like, okay, this is cyclical, something's happening. I don't know, man. I feel like we're talking about a lot of things that are also just breaking connections. You know, we're getting like technical breakdowns. We're seeing like the weirdest labor market where what I see this morning that jobless claims are down, but like we're literally like seeing layoffs every single day. Like Amazon's laying off people, UPS is laying off 30,000 people, Amazon's firing another 15,000 workers. I mean, big tech hasn't hired since 2022. You know, and it's still the same, the way that the trend is going. And, you know, we still have this like I wish we would get some labor data on the gig economy. Everyone that has a 1099, I wish we could figure out like how that plays into the BLS data, because it's misleading to tell everyone that you've got like a 4.4, 4.3 unemployment rate, and yet big tech is cutting tens of thousands of jobs. Our non-farm payrolls are embarrassing every single month. It is harder and harder to believe that our data that we're getting from the news is actually trustworthy and meaningful, and the market actually cares about it, because it's just not. Like, I mean, I'm reading Trueflation. That is a lot better gauge to me than looking at a monthly CPI report.
Sure.
So, and we'll see if it reflects it when it comes out next.
Yeah, you're talking about some crazy disinflation trend.
A huge drop. Yeah, huge
drop.
The
question is what gets a what makes inflation move like that quickly? Is it drying up of consumer spending? Is that what kind of gets you there? Is it weakness in the consumer? Is it oil prices, you know, still relatively low? Like what gets it to make that kind of move?
Well, I'd honestly have to dive in a little bit deeper to like what they're actually pulling here, but I know they're pulling like thousands of data points. Yeah, I do think that every company right now that is talking about integrating AI in some capacity, you know, the sectors that AI should be benefiting in now, obviously like tech should be the thing, but my fear with getting all in on tech is because the easy money in tech was made in 2025. I think 2026, you want the build out to be in, if we're going to have industries using AI, you want to be in healthcare, you want to be in financials. Those are the industries that would benefit from AI, because they're going to take away a lot of the paper, the paper pushers, the middle management, the executive assistants, like all that stuff can go away and be done by agents or one person. As far as the scarcity, XLB, XLI, XLU is not a cash cow, but I'd say XLE is going to be your energy play. XLU is not a cash cow, but XLU is going to be, I mean, if we have like blackouts and strain in the energy grid, utilities will do pretty well. The problem is they have such high overhead. I don't know if they can really add the AI component. So if I'm going AI, I want to be in the physical build out of AI, which is going to be these three. If I want to benefit from what industries can benefit from now having AI integrated, it would be healthcare and financials. And then utilities would be just kind of the safe blue chips, like the safe dividend makers, the safe, I'll call them like cash cows. Is they're steady, they're low beta, they're low volatility, but they tend to perform well, especially when they're, needed by everybody. We don't have the proper infrastructure for a booming AI. It's like, we need to build this crap. And that's what is so exciting about this whole revolution, is a tech revolution that is probably truly more important than the internet. But if you remember what happened with the railroads, remember what happened with laying the fiber for the internet, guess what? It left casualties and victims that were thousands of miles wide. And afterwards, those that survived became some of the strongest companies in the world. But I don't think you can pick the top dog here, Nick. I think you have to pick like the sectors, the industries, the scarcity, and benefit from the market as a whole, as this becomes like the positive narrative. But I don't think you can pick like who's going to win the AI race. If it's one company, dude, I would never be confident in that pick.
Yeah, and I'm with you on that, because I would have a hard time. You and I our specialty is we stare at financial markets all the time. There's people in the AI world that know so much about it, and they will struggle to pick the right companies to determine, which ones are the best technologies. And,
Right.
last year, everyone thought Google was down and out, and then it turned around and became like the best AI model.
Right.
So
Now it's better. It's better than NVIDIA, Gemini.
right.
Yeah.
So it's almost like maybe the strategy, I'm with you on that in terms of if I'm going to pick an area, it's probably going to be through an ETF. I've told you this before. I like the idea of buying cybersecurity. If we get some sell-offs in the market this year, I would probably be hitting the bid a little bit on some cybersecurity as a collective group, like the cyber ETF, CIBR. It's already been down a little bit. I would just love to see if people got a little worried about a hawkish Fed, if you got 20% off, 15% off on the cyber ETF, I'd probably go a little shopping in there and feel decently good about it. But yeah, to your point about the build out too, right? Like if we take a look at, it's a really interesting time, because if you have this circumstance where we are going to go into a spending super cycle, we have Japan doing it, right? Talking about they want to be more aggressive and they want to grow, and they're willing to expand national debt, which is already massively high. There are serious risks to there, but that risk has the potential reward of Japan kind of coming back to life. It's kind of the same story in the US, where it's a risk because the administration wants to spend like crazy, and the hope is that we can outgrow and that we could potentially become even more centric to the global trade again, strengthen the dollar, et cetera, longer term. I don't know. It's an interesting story. But the point is that if we're going to give that a shot, if that is going to be the attempt of the administration in the few years coming, that's a lot of spending that goes into industrial. It's a lot of spending that goes into energy. It's a lot of, build out, because that's where the money would go, right? If we have this one shot, is like, you got to win the AI race, just like the space race. That's a ton of fiscal spending. And hey, maybe there is massive boom cycle growth on the other side of it. Maybe it's not necessarily equally distributed wealth. I would say almost certainly not. But the point would be, if AI if the US is going to go all in basically on AI infrastructure, that's a huge spending cycle. And with lower interest rates, I mean, that's where it's like, it's hard to get, for me, really bearish on you're in that case. You're talking about a secular technological trend. You're talking about a fiscal policy that wants to spend like crazy, and the Federal Reserve that most likely wants to continue to cut interest rates. That's a tough wall of bullishness to like get very bearish on. Now, I'm not saying that, we should just go out and go all in on the stock market. I'm just saying constructive dips. I'm a buyer of dips if we get healthy corrections, healthy pullbacks this year.
Yeah, no, I agree. I think and ultimately you have to stay the course, because I think that's where the market is going. I think the market is, because of all the things just mentioned, it is going to be tough to turn the Titanic to a bear market. I think that you keep plugging away, you crack through some icebergs, and you keep forging forward. I think the only thing that maybe puts a wrinkle in that is the fact that our debt is continuing to climb. The debasement continues to accelerate. And, right now it's like, this is a big window for the US to be lapped by the world. And I mean, for us to sit here and brag, like, we're going to lead the world in AI, it's like, well, but our dollar is 20% cheaper. Our gold is outperforming our entire index. And GLD is the best performing ETF the last 25 years outside of our S&P 500. Like, that's embarrassing.
It is,
but
crazy.
that could be the reality here over the next, last year to this year. If gold continues to run like it is, I mean, dude, GLD over SPY could be like a 25 plus year. Like, if you look at the long-term performance, you could have, I guess we could just put it on the chart. Let's see how far back this can go. Let's go GLD versus SPY and go back on a weekly time frame.
2005 to now, gold is winning.
Yeah.
Crazy.
It's nuts, right?
From 2005 to now.
And if this has anything to do with a rally coming that's going to continue, it's like, could you imagine what this looks like for, gold holders with like that type of like outperformance? I mean, on a positive note, it's like, that's why it's great to have in the asset. It's great to have in the portfolio, because it's one thing where if you just think about, if I want to save money, if I just put some money in gold and it maintains my purchasing power, in fact, actually appreciates and gives me more purchasing power. Like, I can take less gold and buy a house now versus what we have in the dollar, which is it takes more dollars and more dollars and more dollars to buy anything. So less gold to buy a house is great. Less silver to buy a house is great. Less Bitcoin, hopefully, if we hit all-time highs, is great. But
Yeah.
I think this is, I don't know, man. The fact that central banks are net long, biggest banks in the world are net long, there are definitely some tailwinds. And all I'm saying is please just give us a correction. That's all I'm asking for. Just give me a chance to feel like I can get a better allocation into this after, being patient for 3-4 years and trading what I thought was a good trade, and somehow feeling like, man, did I really mess up this trade?
Right.
I followed my plan and I still feel like I didn't do well enough.
Yeah, no, I mean, and for listeners, Chris has been playing gold and silver for years now. We did excellent. You did excellent with it. It's just the chart absolutely broke. Something just really the structure of this thing completely broke to the upside. Silver, gold, etc. Just completely crazy. One thing I'll say, Chris, to balance out what we were talking about, the bullish case, right? The idea of fiscal spending, the idea of the Fed, the idea of a continued tech build out. I agree. Actually, you probably want to see it rotate into other sectors for it to keep going. But one thing I would say, the biggest potential risk to me in the markets, not any surprise to our conversations, is going to be the bond market in the U.S. and Japan. I think that's like front and center this year for me. Is if you get a scenario where not necessarily just the nominal rate, but if you were to see interest rates in the U.S. start to go on a run, like to the upside, meaning the bond market gets sold hard. If we see something like what's happening in Japan, if that happens in the U.S., that to me is a reason to get defensive, because historically speaking, we say it all the time on the stream. The two things that actually cause tangible market sell-offs that historically speaking have caused them is a blowout in oil prices due to geopolitical events, can cause spikes in inflation, and the other one being a very rapid rise in interest rates.
Right.
So if the Fed were to have to, I heard you say it earlier, if the Fed were to have to pivot and start hiking interest rates for whatever reason, no, it's not tomorrow. And I think that's why we still have runway to this market. But when that starts to shift, that's where I think we have to actually take a closer look at, being cautious on the market.
And I think for the bond yields, I mean, U.S. and Japan are the two biggest markets that are probably being watched the closest, because I mean, the U.S. is now 120% plus GDP, debt to GDP. Japan is 200+% plus debt to GDP. Two very liquid and solvent financial systems. I don't think the market really cares, Nick, if we're between 4% and 4.5% on the 10-year. I do think the market cares if we're at 5%. What this market is telling us is, look, you guys want to run these fiscal deficits, you want to run these debts, you want to print money left and right. We want more premium. You want us to hold your debt, you want us to hold your treasuries, give us 5.5%. Give us something better than what you've been giving us. And it's tough to service that, dude. I mean, when you're talking about the US especially, right now, like our interest expense on our debt is one of our top 3 line items. It's as big as the military, maybe even eclipse the military. But now Trump wants to do another $1.5 trillion to boost our military spending. Where does that money come from? I mean, it gets printed. We've put like 20+% of global fiat circulation in the world. Like we've added like another 20% since 2020, just the US dollar alone.
Yeah.
Like it's crazy what we're doing. But I'm trying to think of the exact saying. The governments will continue to spend until the bond market takes away the keys. So the bond market, like you said, like it will ultimately be the thing. And I think that the big threat to the bond market is higher inflation will change everything. Yeah. So right now, like we are getting lower inflation. We are getting, real readings showing a depressed inflation, which is good. But if this starts to spike up again in any way, shape, or form, it will change the dynamics of the bond market. I mean, we need some type of inflation to grow.
And we know the most volatile aspect of inflation usually is energy, right? So that's where we go back to what we just talked about. It's usually a blowout in oil prices, which not always, but historically that can be a major deterrent to the overall markets. So right now, not a huge issue, but something to continue to keep an eye on. Chris, just a quick look. We do this every time we're together. Take a look at some sentiment here. Crowd sentiment still pretty bullish on this market. 43.2% of market respondents to the investor sentiment survey marking that they are feeling bullish on the market in the next 6 months. You only have 33% of respondents saying they feel bearish. Of course, this is not necessarily a perfect contrarian indicator, but it's something that we pay attention to, especially when you get a reading like 49.5%. That is very, very bullish sentiment in this market. And just to also layer onto that, the put call ratio here, taking a look at this one, you can see S&P 500 hitting the call volume bid here recently. So we are seeing a little bit more favoritism towards upside from the crowd. So I would say, that continues to keep me a little bit cautious. I when it comes to stocks, I'm loving the idea of a pullback if it takes place. And I kind of see limited upside personally with the whole Japanese bond market stuff that we keep talking about in the short run, or at least I would only really be enticed, say it another way, to potentially get long or add stuff to my portfolio if you were to give a pullback first.
Sure. I think that, maybe a replay in some capacity of 2024, that July to August window where it was like the yen trade is unraveling, the carry trade is unraveling, and the market had a flinch reaction for 2 weeks. The Nikkei was down over 20%. The U.S. market dropped 10%. That was a nasty move, but it was quickly resolved within like 10 days. And then we're back up to highs and we never stopped going up for 2024. Yeah. I could see something like that where it's essentially a flare up. Like that was a 2024 volatility event. If you bring up the VIX here, you'll see that spike in 2024. That was July to August. Yeah, look at this. It's like you couldn't even trade this VIX because it happened like over the weekend.
I remember that
was the July to August. That was a Sunday night futures open where the markets were down like 4 to 5%. And then as soon as they opened up on Monday morning, down 4%, they ripped up to like close the gap and they never stopped going up. So, but it was a one-off VIX event. And that was like I said, it was like the carry trade unraveling. So they said, and it was right back on after that, dude. And then it was like here's Liberation Day. And the fact that we are just suppressed volatility, I just think like the market's probably going to give us another one of these this year. I don't know what it is. It could be Japanese yen bond related. It could be yield related. It could be gold related. I have no idea, but I'd be shocked to see the VIX do this all year.
Yeah, me too.
That'd be really surprising.
Chris, what do you think about the dollar? Dollar blowout to the downside here recently, 4-year lows.
I think it's a fake out, man. I really do. Yeah. So here's why. I think the fake out is high, low, symmetry got hit. I think this is still playing around with a flat pattern. So I think we still have to spend some time in this consolidation before this maybe turns permanently lower. To me, this looked like with today's candle especially, and I could be wrong. And how am I wrong? If it goes lower, I'm wrong. But if this is lows that are getting tested again, like that low got tested during FOMC and it went up. If this low gets tested and then we put in a bottom and the dollar starts to work its way back up, I think we're stuck between like 96 and 100.
Yeah.
So I just think for a short-term trade, if you're right, and this is dollar strength, that's a very low risk, high reward trade. If you're wrong, get out immediately. If you're stopped out with fresh lows, like just get out. Because if this does break out, you can see my measure move here in the boxes, high to low, high to low. If this is a wave 4 pause and this is a wave 5 continuation, I've got a measure move down to 87. 87 on DXY. There's plenty of downside pressure there. So the one trade that I like right now, currency-wise, is I like New Zealand dollar. I've been long this thing since about 57.50. We are getting closer to my measure move target. I think we get up here to like 61, but also I like this level all the way to 63. This one is one of the only charts I'm like, okay, we still have a few hundred more pips that I can measure. So I think New Zealand dollar buying dips going up to 63.50 or so. I think that's a really good looking target. Nice. Dollar CAD has room to fall a little bit. We started to roll over here. Dollar CAD could fall to like 32.50. I mean, oil prices are up a little bit. CAD economy is always questionable. I mean, I listen to some smart Canadians that are like, the U.S. thinks it's bad. It's like the Canadian is way worse. Canada's way worse. Sure. Their people are happier. The people are nicer, but their economy is also kind of a mess. So anyway, there's still some room to get down here, but I'd say I like the New Zealand dollar better. Just in terms of commodities, I think in terms of proximity to China and Asia, I think New Zealand dollar is looking good for another few hundred pips to the upside. Aussie dollar, it hit my target. I was long in here on this chop. We talked about this a lot last year. I can't believe how slow this thing behaved, but I was long. I wanted to get longer at like 6,300, 6,250. Never got the chance. I just stayed in here with these like little dips at 6,450, and I hit my profit target at 69. So I'm out of this trade. But it was stupid the way it was so slow and behaved, but it did ultimately hit my profit target.
Yeah. Forex trading 101. Chris, you've been trading Forex almost the longest thing you've been trading, right? It's you started in stocks.
2000 was stocks, like, just dipping my toes in the water as, I was a kid. I was 18, 19 years old trading stocks with my brother, and we got a little investment club
That's
going.
right.
But when I was like starting to really cut my teeth in trading, I was learning from a professional day trader that was running like a $25 million currency fund.
That's right. On the golf course.
He was a member at Doral, and I was in Miami at the time in Coral Gables, and I saw this guy every day. We traded together. We played golf together. It was, taught me a lot, and I got really excited about, I'm going to try to figure out how I can trade. So I worked my butt off and tried to make as much money as I could. Had a little nest egg so I could trade, and made some pretty good money in Forex, and had a couple years that was like lightning in a bottle. And once I got to that point where I was looking to preserve, and we had survived the great financial crisis in that little investment club, and I looked at, like, how do we protect that? Like, I mean, our portfolio was down like 40% in 2008 in stocks. So I started looking at, like, how do you protect that stuff? And instead of losing all that money, we buying puts or selling covered calls and basic option stuff. So it all kind of came together like 2011, 2012, adding more dynamics to my stock portfolio, incorporating options. And then once I got into like 2014, 15, 16, way more familiar with income trading. And I didn't want to really own anything in stocks. I just wanted to trade options. And then currencies, I ran a fund from like 2011 to 2022 is essentially when I called it quits in like a managed fund. Reason why I called it quits is because my brokers kept switching servers on me. My robots kept getting disrupted. And I had multiple disruptions on spreads, commissions, margins getting changed on me. And I'm just like, you know what? Like, F it. It's so inconvenient to trade Forex right now. I have way too much money in it, and I'm going to start diversifying away from it. So I got everyone into, mostly indexes, stocks, options. And, Forex is just a sliver now. But I still do well in Forex. It's just, I don't need to put that type of emphasis on running an $8 million currency fund that I trade zero leverage and have no control of what the brokers can do.
Right.
They increase margin by double, triple overnight. That's not good for me. I don't like to use stop losses. I like to trade very small. I'm very responsible. And I still have positions that, like, oh crap, I was down, 3% drawdown that just turned to 6 or 9% because of margin requirements. Like, that's bullshit to me.
Yeah.
So, and you talk about robot trading. It's like, I've had my servers probably changed on me a dozen times, and I have open positions. And when they disrupt my robot, they disrupt all my open trades. I got to go in and manually take care of like hundreds of positions. It just became a huge inconvenience. And I'm like, it's not worth it. So I started just scale that out strategically where, I trade currencies. I still got a 6-figure account that I look after. And that's fine, but it's like, it's just a fraction of what I do now.
Yep. And it's currencies, in my opinion, best way to trade them is to be really boring with it. And so anyways, we just had rates come out as expected. So no surprises there. And if you're newer to these types of events, if it's your first day trading a Fed day, or you're newer to this stuff on the fundamental side, usually this doesn't cause a big move. Markets are pretty dang smart. They've already figured out quite a while ago that we were unlikely to change interest rates. What's more likely to move the markets is the unknown, which is the press conference. So the press conference in 30 minutes, we share this breakdown every time we do these streams. This first move is usually not a very big mover. It is usually the press conference itself where you get the more decisive reads. The way this works, the market is always looking ahead. And so by the time the day of the decision to cut, hold, or hike interest rates gets here, the market's already figured out what it's going to do for a very, very likely probability, like a 99% chance today. We knew Fed was going to hold rates steady. The bigger question is the guidance for the future. Where are we going with interest rates? The market cares about where we're going, not where we are today. And so with that said, in 30 minutes, we have the press conference with Jerome Powell, which is going to be one of his last press conferences. And probably we are not going to get another interest rate cut from Jerome Powell's from leadership until the next cut will probably take place under the next Fed chair, which is actually leading now is to be Rick Reeder. So we'll see, at least in the prediction markets, what that brings to us. So far, market reaction, you have S&P 500 not really moving too far. This is an hourly chart. So the last 1 hour, we haven't really seen much of a change. NASDAQ, same thing. Bitcoin continuing to be a little under pressure here. If you take a look at gold's taking on just a tiny bit of pressure here. Same with silver. Oil's flat, and dollar index somewhat firm here on the rate, remaining unchanged for now. So press conference will be more interesting, I think. And until then, we'll continue to watch these charts for any major developments or major moves. Chris, what do you think about you gave a response non-verbally to Rick Reeder? Do you know much about him? I don't really know that much about him.
No,
he's a super dove.
I just know that the same days where everyone that's in the Fed and the government has been pulling from Goldman Sachs, now they're being pulled from BlackRock. So, but no, I saw a funny. It was on Twitter X. So it was like, this guy's going to cut rates 25 basis points for every shirt or every button he has undone in his shirt. Because he went on, it was like 3 or 4 buttons down. I'm like, talk about a casual, like a business casual attire. It was just a funny joke. But no, I mean, I know who he is from BlackRock, but now he's getting thrown in the ring. It's like, I don't think anybody really knows who it's going to be. I really don't care. I don't think it's going to matter. I think that if you look at what the Fed is doing, remember, it is a council, right? Like it's 12 members. So one chair does not, like, one thing that Powell did, and I don't think this was really the intention of Powell until things got really disruptive between Trump and Powell. Powell became basically like an empowerer of the Fed members, because he's like, look, go talk, do your rounds, say this. Like, I just feel like all the Fed chairs, we had dissent under Powell, like way more than before. And I don't think that's because of a disconnect. I think it's because of more transparency. And I don't think the market loves that. I certainly didn't love it. It's nice when a Fed chair just steps in, says something very vanilla, and it is what it is. But so much indecision, so much wait and see, so much, what is the Fed going to do? And it's like the market it just sits and waits for like, oh, it's a Fed decision. Let's see what happens. But right now, I mean, basically under Powell as chair, nothing's going to change. And we get into June. It's like, okay, so this window from June to October, maybe one cut, and then maybe one more by the end of the year. So that's where we're at. It's like, and the market's already anticipated this, and those priced in last year. I think when the Fed started to end their quantitative tightening, started adding $40 billion back into the markets, and they forecasted 2 cuts potentially for 2026. I think the market, that's why we had such a strong bottom in October and November after we had those like single day sell-offs. But here we are, maybe a 1% higher. The market's obviously down net on the day, but nothing's really going to change until Powell is gone. And I think that, again, any comment from Trump saying we need to lower interest rates.
Sure.
Dude, you can say it all you want, but it doesn't change the fact that the long end of the curve is not going down.
Yeah, and there's some mechanical things I've been thinking about too with the whole Japanese bond situation. If the U.S. cuts interest rates and the long end were to come down, does that not put more pressure on the yen carry trade if you're getting less yield on the carry side? Meanwhile, Japanese 10-year is rising. Doesn't that potentially incentivize an unwind in regards to the carry trade? It's something to at least think about.
It does, unless the U.S. is behind it.
Sure.
I mean, look, one thing I looked at this morning, and I couldn't bring myself to do it, Nick, but I wanted to buy Japanese yen futures so bad in the last like 30 days. Like this has been on my mind, but this is what it just proved to me. This chart of 6J, which is Japanese yen, it is the inverse of the dollar yen. It is not the yen basket. So if you look at the yen basket, they're not all correlated. Everything is now showing dollar yen movement, and the Japanese yen futures market is because of that dollar yen movement. So I didn't trust, and rarely do I trust the yen, but I didn't trust that the yen would move as a basket. But what we are seeing is the dollar's making that big move because the dollar's getting weaker. I would still take it a fine risk trade at it. I don't know if I would trust it enough to say that we're going to have this huge unraveling, because at the end of the day, here's what it means. If you want to get long the Japanese yen, or in fact, you want to get short the dollar yen, do you think that if the dollar yen were to drop 2,000 pips, that the equities market should be sitting at all-time highs?
Probably not.
Probably not. So that's why I can't take the trade, because I don't think that that's actually going to happen. I think the markets are still going to find a way to grind higher. And all the stuff on the yen is going to be noise. We could have it be a catalyst for a short-term correction. But I do think that the U.S. and Japan will probably have to work pretty closely to make sure, like, look, you guys are going towards this debt bubble. So are we. Let's not F up the entire market. I think there's going to be some way they got to figure out how to creatively account for what they're heading to, which is just like this debt spiral.
Yeah, I think it is a more collaborative thing than some people are thinking about. Like the Japanese situation is the U.S. situation, right? The Japanese are the biggest international U.S. Treasury buyers. Like if you have a giant customer, you're going to try and take care of your best customer, right? So yeah, it's an interesting dynamic to say the least. We'll see where it all goes. Watch that. The yen is weakening off here a little bit here. Taking a look at the JXY. Gold, silver, of course, we already talked about, just flying to the upside. What about the Nikkei? I'm long the Nikkei. I have a small long position on it. My thought process is just from my limited understanding of Japanese fiscal spending, it's somewhat similar in the idea that you have a fiscal policy government that wants to actually try and grow Japan. It's so fascinating. There's so much commentary on this. I've been listening to a lot of it. So much commentary around the strategy for Japan, and they're taking the high risk, high reward type of approach right now, where the government, the leadership there is like, all right, let's essentially keep monetary policy, let's keep fiscal policy very loose to try to start growth in Japan again. And it's an interesting one because, what that does is as we've talked about just a moment ago, the bond market here is, okay, so you're going to spend like crazy. And we need a higher risk premium. If we're going to lend money to the Japanese government, which is going to spend like crazy, potentially devaluing the yen worse, we want higher premiums. So it's a fascinating dynamic. I think that the yen weakness is likely to stay there. I think that if the Japanese government is on board with wanting to keep spending going, competitive on global stage, I like the Nikkei. So I have a long position with a small stop. I'll cut it if it breaks. I want the thing to keep moving with momentum. Otherwise, I'm out of the trade.
I like Nikkei long. I think the smartest thing for me to do in currencies is just not do anything on the yen. I don't trust it enough. I don't trade it well enough. I just know myself. Like, I'm a much more like pure structure, technical efficiencies, pocket type trader, and the yen doesn't behave like that. So it is not the currency for me. It is if you trade what you see, that's how you trade the yen. Have a stop loss, have an exit plan, go with the flow, stick with the alignments. Like but that's not my style.
It's very trendy.
But if you're like that, like, trade the trend. When it starts a trend, it'll last for 3 to 6, 9 months, and it will be like 1,000+ pip trend. Those are great. But when you have also 9 months of chop, that'll drive you crazy when you're just waiting and begging and looking for a move that never happens. It's like, I just see more people get beat up so badly by the yen because it's all or nothing. It's all trend or it's all chop. And it's just so inconsistent for me that, look, and I've spent a long time trading currencies. I can say I've got 18 years in the currency market, and I've had plenty of bad experiences with the yen. It's probably been, if I could reduce those to like, one bad lesson, and not more than that, then I wouldn't be so offended by the yen. But it's just a challenging currency pair when you see it do amazing things and you want to jump on board, and then you realize, oh, it does that whenever it wants to. It's not really something you can predict. People have been like the carry trade stuff. It's like people have been long dollar yen since I'm trying to think dollar yen here. When we had like the test at 140, or this run from like 140 up to 160, or heck, the 120. The 120 to 150. That was a beautiful trade. But notice how that happened over the course of maybe a year, and then we have gone literally nowhere for the last 2 years. Nowhere.
Yep.
So it can drive you crazy. That's all. I call it the widowmaker. I know that everyone calls natural gas a widowmaker, but I call the yen the widowmaker for currency traders.
I think that's a totally fair. It's very volatile. It can move very, very dramatically. Just an update. There's so much to talk about. We have precious metals. Currencies are actually interesting again right now, at least in my opinion. There's some real interesting stuff going on with the dollar and with currencies. One thing that's happening right now, you've got NASDAQ sitting at all-time highs or trying to claw back to all-time highs. We've been in a sideways market for the NASDAQ. It's been a long time since we've seen one, but oh my goodness, we've actually got, let's call it 3 months or so where you've had the NASDAQ kind of trade sideways, though now we are back to the upper end. The question is, are we going to get head and shoulders back above and start continuing this grind up in the NASDAQ? I think for me, I'm cautious. I mean, I think that I'm not willing to short the things in a longer term upward trend. Just plot your moving averages. You've got a long term upward trend here. We have retested. I mean, this is kind of an ugly but choppy pullback that seems to have gone on right now. Sitting at all time highs. There's a lot of growth stories that are going around that I think are great. I'm just a little cautious on valuation, and I think the risk to reward is just a little sketch with all this bond market commentary. That's my thought in terms of investing. From a trading perspective, you get the solid breakout to the upside. There may actually be some opportunities here with a tight stop, trailing stop, to see if we can keep running hot on this stock market. So I lean neutral to slightly bullish.
On NASDAQ. I mean, it's a pretty clear level. If we clear the highs with a closed candle, I think there's room to run. If we show this rejection and we finish up this month and we have a fresh month of February, that unfortunately that first week of February is going to be kind of a make or break of whether or not we do break higher, or if we we had a good run, good flows, the leaps are done. Now it's time to see where the market has this weakness window. All of our big corrections we've seen the last 10 years have all have come in some way, shape, or form between February to April.
Yeah.
COVID did it. 2022 rolled over in mid-January. 2020, I'm trying to think, 2025, the weakness window was literally March to April. It's just a pause. And so that pause can turn into something worse. I don't think it's going to be out of the ordinary to see 5 or 10% fast in 2026. But also just as fast as it goes down, we could also have the everyone's conditioned for a taco trade now. So hopefully it's going to be another one of those opportunities to buy the dip. Pete, Tom Lee's on it for Fun Strat. I mean, anything in 2026 is an opportunity to buy, which I agree. It's just how ugly does it get, So One thing really quickly on my day here, Nick, I was calculating this morning on SPX. So, the Fed is kind of big nothing burger. We have earnings coming out after market. Microsoft, Meta, Tesla today after market. I do think that for the S&P today, we poke 7,000, maybe a, kind of an internal celebration for the markets that we hit a big round number. We retreated a little bit, not by a lot, only 30 points, which is not a big deal. FOMC is moving nowheresville. And then Powell comes up in 15 minutes to see if he says anything that the market cares about. I think it's still going to be just a big, fat, nothing day. Then we have earnings for the rest of the week, and we'll see kind of where things fall after Meta, Microsoft, Apple, and then energy on Friday. But that's going to be the first month of the year. And then February, I just think, I guess we can go higher, but I'd rather see a dip. I mean, I think I'd like to see one because I want to trade it. I'm not saying I want to see one because I want to deal with a drawdown. I'm just saying I want to see a dip so I can actually position for it. So I don't want a 2017 type year. I don't want the market to grind, fractions of 1% higher all year long and finish at 11, 12% for the year. I want it to be either give us a dip so we can have, if it pulls back 10%, we have an 11% plus rally to get back to those highs and then some. Great.
Yeah. Most traders don't love years like that for good reason. It feels like a waste of time. You should have just been sitting in the index, So a nice year is where you actually get some volatility and a trader can actually carve something out of the market, as opposed to, if you just get an everyday up by 0.25%, 0.5%, it really feels silly to be trying to trade because the market itself is just, and that always happens every time people, I've seen this for years and years and years. Whenever the market has had a really good stretch, you'll see comments of people saying what's the point in trading the market? You just do better sitting in the market. And then nobody's saying that when you have a 2022 or, everyone's a stock picker's genius when you have really great years.
Right.
But then it's, a lot of people give that back during down times. Anyways, speaking of markets breaking out and doing really well, Chinese stocks flying here. Chris, you were playing Baidu the last time we talked about it. I think you.
Yep.
What's Baidu doing? Is it doing okay?
It's doing great. I am out of my chunk of shares on Baidu.
Okay.
I am just sitting on some naked puts down here at it's a ratio spread, the 90 by 85. And I'm just kind of doing a reset because we did spend a lot of time not breaking this 155 handle. So, I mean, Baidu is technically one of my favorite setups because this low to high, if this is a double top, we break that level, this is going to double and probably be a $270 position. I've got it measured here. 240 to be my target. So I am bullish on Baidu, but expect there to be some, wild and crazy, maybe channeling along the way. If this is how it plays out, I could see that happening. In also typical stock fashion, if we break here and it gives you a chance to buy in, you want to get long that because that's open space. So that could be a big runner in Baidu that I'd be okay with. I don't know if I love it that much because fundamentally, here is Baidu fundamentally. It's okay. Earnings are going to grow. It's cheap as far as price to earnings, but not super cheap. It's more expensive than Artec. And then we have, cash flow and discounted cash flow, $100 fair value. It's like, I don't want to chase this thing to 240 when I made all my money from 80 to 150. Like, sure. I'm happy being out of the trade because I closed out my shares. Now it's like, if I'm going to take a stab at it, it's going to be down here. It's going to be down here. Like, I'm probably not going to chase that 150 to 240 move. It wouldn't surprise me if it happens, but I'm not going to hold and hope. So that's Baidu. Baba's the other one that I've had exposure on. And this one is also like, it's funny how the timing has been totally different. This one's been up and down and up and down and up and down. It's a nice channel. Okay.
Yeah.
It works out well. But, this was happening like Baba outperformed here. And now you see that Baidu's at fresh highs. It's just like it's almost weird how they just cycle back and forth. And they're still like, one is the Google of China, one is the Amazon of China. So they're not the same company, but you look at our Google and Amazon, they're also not behaving the same way either. Yep. So I think they're two good plays. It's just, pick your battles, sell some puts. That's it at this point. You've had a good run on shares. I mean, and this, Nick, like I was early, man. I was early to this Baba stuff early. I mean, I was in this thing since 2022 when nobody liked China. And I was like, all right, I'm going to take a stab at it. So I've held it for 3 years and finally got paid pretty well, but I don't need to chase this thing any higher.
Yeah, Chinese stocks have been, it's an interesting place, and we'll see, weaker. The reason I asked that is because I was going to come back and talk about the dollar for a second again.
Yep.
Weaker dollar, I was looking at a chart. I mean, it is pretty inversely correlated with the performance of international stocks. And so when you're talking about weaker dollar, that's usually good for international stocks. When you're talking about stronger dollar, that is talking weaker for international stocks. We've had, for the last quite a while, last decade or so, you've had a strong dollar. And so if we are, actually challenging dollar downside, how far does that go? And so I think it's kind of interesting because I have a mixed view on the dollar. I don't see a giant drop off in the dollar that's going to last, a decade.
Right.
Personally, I think if we're looking at two quick indicators, these are new indicators. I think you might have be talking about this, Chris. We worked on this over the weekend and I'm really excited about them. But this is the new, Edgefinder's Economic Surprise Index. Really simple concept for people who are familiar with surprise indexes for economic data. It looks at all the Edgefinder's economic data, and it looks at the percentage of those indicators that are stronger than expected versus weaker than expected for the currency. And what's kind of interesting is when you look at the dollar by itself, it's been outperforming expectations. The challenge is there's a lot of currencies actually coming in really strong. New Zealand dollar coming in very strong versus expectations. The euro's a little upbeat here relative to expectations. Australian dollar, it's actually the Swiss franc getting a really weak reading compared to expectations. And then the Chinese yuan, which is interesting. So you just have this scorecard here that's looking at CPI, PPI, PCE. It's looking at GDP, NFP, like all these different major economic data points to build a surprise index. We've also added this chart at the bottom here, which will show it over time. Now, we just started tracking data, so we don't have a lot here, but over time, you'll be able to look at currencies over time, which ones are sort of building economic strength momentum relative to forecasts from economists and which ones are underperforming. Then there's one other chart just to show you this one. This is where I actually kind of see on a longer term basis. Sure, we could have some downside in the dollar, but I think it's limited in the longer run because this is the economic strength index. Now, what this indicator does, it's a longer term fundamental indicator of currencies. And what it looks at is a relative strength. It has an algorithm within it that looks at relative strength across GDP growth, unemployment rate, interest rates, and CPI, as well as real yields internationally amongst the major currencies. And what's really nice here is this is building a little bit of a profile. You mentioned like Canadian dollar getting some weak readings earlier. Like there it is. You have The Canadian economy is seeing higher unemployment rate. The real yield in the Canadian dollar is actually negative when considering current CPI and interest rates. And so this kind of shows you on a longer term bet. I actually, you know, our good friend Rob Booker, I heard him say in an interview actually recently, is like the only game long term in currencies is the real yield game. And I thought it was a really smart point. And so you know, I think it's a good point. So anyways, GDP growth in the US still strong, unemployment rate low, interest rates. Like if you just know not everything is perfect in the US.
Correct.
But if you sort of look across the lexicon of currencies, the dollar to me doesn't look like this big loser compared to the others. It actually still looks relatively strong. And so short term, dollar index is in a downtrend. I get it. Long term, though, pull out that monthly chart. And the question is this one big pullback? And maybe is, you know, US dominance. The question is, as we pull back, we see this longer term trend line breaking or potentially breaking. It depends how you draw it. This is the problem with trend lines, is you can different ways, right? We're sitting right there at it. So it's a question of where do you think we're going? Is US dollar dominance going to stay or not? Real quick, and I want to get your response too to this. If you guys want to try out the Edge Finder, we'll drop a link here in the chat to where you can apply for an Edge Finder trial. We also offer a free course on how to use the Edge Finder. Even if you never buy the Edge Finder, the course itself is tons of value. It can help you to understand how macro can impact charts that you care about. So we'll drop the link here in the description right here. Boom, get an Edge Finder trial and take advantage of that right there. Okay, Chris, what do you think? Dollar index, are you kind of thinking something similar, like dollar index? How much downside?
How many times do we hear that the U.S. is the cleanest dirty shirt in the laundry or something like that? That was said all last year, and I feel like that's kind of true today. I mean, I said earlier, it's like I do think that this is a really crazy window that the U.S. can be outperformed by the world, but it doesn't mean that the U.S. is declining. It doesn't mean the U.S. is suffering or struggling. I think if the U.S. doesn't want to be second, third, fourth. The U.S. wants to be number one. Right. You know, we say that we're number one. If we're going to spend $1.5 trillion on our military, we probably will be by force number one. But anyway, point is, I look at those currencies and it's hard for me to be like, oh, this economy is way better. I mean, there's going to be ebbs and flows, but I think that the crowd has also been buying into this very noisy narrative that the dollar is going to get weaker and the U.S. is going to fall off a cliff. And it's like, I mean, if the U.S. falls off a cliff, you have to remember the whole world's coming with us. We will take everyone with us. If we go down, the whole world's coming with us. We're all drinking the same Kool-Aid. We all have the same debt problems. It's like this financial market, this financial game is leveraged to the teeth. And we can't afford, the world cannot afford to really see anybody have a recession, let alone the US, let alone China, let alone Japan. It can't afford it. And, you know, that has been kicked down the road since the great financial crisis. Yep. And we will continue to do so. And I again, like somehow, and maybe this is the wildest thing, but what if the U.S. does something even more radical and they seize all the world's gold and then we pay off our national debt? Because we can. It's like, I'm telling you, man, like something wild is going to happen. And I'm not saying it's 2026, but right now, all the stuff you're showing there in Edge Finder, the U.S. is still growing. I mean, the GDP prints are better than they've been in a long time. Like we might see 4.5 to 5% GDP. And even though we have a struggling labor market, it's fine. It's just growth. It's corporate growth.
Yeah. And the rest of the world is just not putting up that type of growth. At the end of the day, one thing that this is where I can't get just outright dollar's going to crash too hard, because I think to myself, I'm like, the AI trade is here. Innovation is here. Companies come here, right?
Right.
That's the challenge of it is, you know, it's like you said, it's the least dirty shirt in the laundry. Yep. I love that. Yep. I love that saying. That's pretty perfect. It's like, you know, the U.S. has massive national debt problems, but exactly what you just said there too. Who owns national debt? All of us, everyone, single one of us, everyone watching this stream right now. Did you know you own U.S. national debt, whether you knew it or didn't like it, or you like it or not. Like, it's just all of us, because if it implodes, it will impact every single person on planet Earth that is part of the grid society whatsoever. So unless you want to I mean, hey, maybe you could go set up camp in the backwoods somewhere and live off the grid, and that's one option. But otherwise, the U.S. dollar crashing it would be detrimental to everyone.
Yeah, and I think that I just think there's more stability in it. Look, if it doesn't look like a clean trade, then don't take it. I mean, if you got a plan on the dollar and your plan is to short it, have a plan, have an exit. If it works out, you're right, great. If you're wrong, then go find another trade. I said last year, like, watching currencies, if I'm looking at something big picture, the dollar basket or the yen basket is going to be probably the most active basket that I watch, and it has the most potential. Like the catalyst could be all over the place, right? Like a big move in the dollar basket, a big move in the yen basket, that's going to move, currencies would move hundreds and hundreds of pips across the board. So right now, it's like the dollar's still kind of range bound. I know we had a big drop for the last 2 or 3 days, but it dropped right back to key support. And if that support holds, I think that it's a buy low, low risk, buy low opportunity, and see if the dollar sticks. And that was just like a bit of a head fake. But I think Trump and company want a weaker dollar. I think it benefits us. But I don't think we want to have like the dollar absolutely implode. I mean, what happens if we see like a Turkish lira type move on the dollar? Like, that's not good for anybody, Right. So anyway, I just think that the narratives get really noisy, and the dollar is still like super liquid. Your dollar basket is pricing a lot of euro. I mean, there's always a mix of everything. But right, like I said, if I'm gonna look at the dollar right now, my cleanest trade is I like New Zealand dollar long. My Aussie dollar hit profits. Dollar yen is the only one that's moving with the yen, so I'm staying out of the yen basket right now. Did anybody get yen short, by the way? Did you get like dollar yen short? If you did, great trade. You had 650 pips to move, but I didn't trade it. I was trying to short it like 161, 162. We never got there. We stopped at like 157.
Right.
So anyway,
Chris, we've got I've got the press
it.
conference here loading. I do also have a stop at 3 p.m. I'm jumping.
That's fine. I've got another session at like 3:15, so that'd be perfect.
Okay. Yeah. So if you want to stick around, we'll just listen in, see what old JP has to say, and should be good. If you want to just mute yourself once this starts, in case I don't want you to hear yourself. I know the echo due to everything, but just going to turn this volume up, make sure we're good here. Okay. And what I'll do here is I'll put on our, let's do this. Let's just clean up this look a little bit. And we'll go, where's my all markets? There we go. Okay. Let me know if you guys can't hear them, but I think we should be good.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months, Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
That was really short.
Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously, and I guess in 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting. And that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. But I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something there's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data implications and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. And maybe I missed by one, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. You know, it's in the eye of the beholder, and of course, no one knows with any precision. So, you got to follow up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, you know, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Mara Moakley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2% x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices peaking and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate. That the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either, but it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer term rates means less accommodative financial conditions. But remember, many things move longer term rates. It's not mostly what happens on the short end. There can be effects of longer term rates from our moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Thanks. Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. Just one reading.
All right, guys, I gotta shut off the stream. We're switching gears here to the live trading session. Chris, thank you very much, man, for coming on, for being a part. I know you got to run as well. We'll see you on the next one if you want to.
All right, I'll see you tomorrow morning.
Yeah, see you, man.
All right, bye.
Yeah, guys, so we're going to be switching gears here, heading over to our next stream event, which is happening right now. We're going to be doing a live trading session on the trading battle. If you'd like to join me there, here is how you can do that. So what you can see here is we just dropped the live stream link there in the chat. So click that link. You can join me there. Okay. Yeah. Hold on. Let me drop it one more time. Here it is. Join me over there. We're going to be live trading this post-Fed meeting. Trading starts now. So now that we've had some commentary from Powell, we got most of it out of there. We are now going to be starting a live trading session over on the trading battle. These are always a lot of fun. We're going to be placing a lot of trades on cryptos, gold, silver, US dollar pairs, Japanese yen pairs. We have a lot of stuff coming your way here, and the trading battle is starting right now. Join me over there, and we will see you. Me and two other contestants are going to be trading that post-Fed meeting live. So click the link. It's in the chat right now, and we'll see you over there.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.